us, short-term inflation dynamics are reassuring, but medium-term inflation dynamics are worrisome, especially with businesses and consumers showing preemptive inflation anxiety. Greg joins us now for more. Greg, good morning. It's good to see you.
How are you?
Let's get to the Fed speak. I'm good. This came from the Fed President Schmidt just yesterday. I'm sure this quote caught your eye too. While the risk of inflation appeared to be to the downside, discussions with contacts in my district, as well as some recent data, suggest that elevated uncertainty might weigh on growth, going on to say the following: the Fed could have to balance inflation risk against growth concerns. Sounds a little bit like stagflation. What's your response to that?
That's going to be the very delicate balance that the Fed is going to have to navigate this year, because we have, as I mentioned, preemptive inflation anxiety. What does that mean? It means that on the business side, businesses are looking ahead at potential tariffs. Even though only 10% tariffs on China have been implemented as of today, they are ready to front-load orders, front-load imports, and they already have started doing so. That in itself is inflationary because it puts upward pressure on supply chains and leads to that preemptive inflation. The other important element is that they're ready to price their way out of this environment. We surveyed a number of business executives in a recent survey at EY, and we found that essentially half of the businesses are going to pass on 2/3 of the higher input cost. That is a big share of the input costs that are going to be passed on. That in itself is also inflationary. That's what I'm concerned about.
Do you think those prices get paid? And that speaks to the stag. Do you think ultimately this time around consumers just hold back?
I think there's going to be demand destruction as a result of the tariff policies that are put in place. We're seeing the administration continue to push again and again on the tariff threats. So far, there haven't been that many tariffs that have actually been implemented, but the threats keep coming. And I think the 10% tariffs on China, additional 10% tariffs on China, are likely to be materialized. The tariffs on Mexico, perhaps not, but on Canada, we're likely to see targeted tariffs. Let's not forget, in the background, you have 25% tariffs on steel and aluminum, and you have the threats of reciprocal tariffs, and I think European tariffs are also likely to come. All of that is going to lead to some demand destruction.
I want to dig into the point that you're making, that even if we don't get all of these tariffs, there still is PIA, which should be some sort of psychotherapy diagnosis code, preemptive inflation anxiety. I'm coming down with a terrible case of preemptive inflation anxiety. How much are you seeing a sense that inflation is going to rise, even if a lot of these tariffs are just negotiating tools because of preparations made by consumers and by companies that are looking to take advantage of that?
I think it's very important because a lot of private sector actors have been through this unusual cycle of high inflation over the past 3 years. And even though today inflation is not really worrisome, it's at 2.5%. We'll get the final numbers this morning, but 2.5% should not be extremely worrisome. What is worrisome is the fact that we have consumers that are seeing a lot of prices and paying close attention to all of these prices. It's inflation salience that is really the risk, because they observe higher prices for eggs, they observe higher prices for cars, for fridges, for vacation, and as a result, they're pulling back on demand. You saw that in the latest sentiment gauges, that we had the lowest reading in terms of vacation expectations in about 3 years. There is much more anxiety anticipating the shocks from higher prices, whether it's due to tariffs or other factors. That is leading to demand destruction.
There was a theory over the past few years, Mohamed El-Erian has come out and been really strong on this, that if you allow inflation to be 2 point something, even if it's 2.8, 2.9, that's preferable than maybe keeping rates at a really restrictive level and forcing some sort of recession. You hear that same sort of tone behind the scenes from a number of economists. Why is this different?
Well, I don't know that it's that different today. What is the risk is that if you look out over the horizon, in an environment where policies are likely to be inflationary, then that can become the risk. In normal conditions, I would not be afraid by 2.5% inflation. It's only about 50 basis points higher than the target. It does not impact the way consumers spend, the way businesses invest. But in an environment where you have preemptive inflation anxiety, that is where it becomes a big risk. That is where it can actually feed off of itself and lead to a self-fulfilling prophecy of inflationary dynamics even before the tariffs are actually put in place. That's what the Fed has to be concerned about. And unfortunately, I think the Fed is going to be too reactionary in this environment. It's going to wait to see the data before it acts up or down. And that is always going to be too late in this environment.
March 19th, new forecasts. How do they change?
I think they essentially have likely higher inflation expectations. We know that there's been a filtering, a slow filtering of incorporating different policy changes. It's been very disorganized and inconsistent across the different policymakers. So you have a forecast that is internally inconsistent because some have policy assumptions in there, some don't. Some we don't know whether they do or they don't. So you have a lot of inconsistency in there, and that's going to be the difficulty going forward, interpreting what the Fed's going to do. Right now, the Fed policymakers are likely to find comfort in a winter pause. They're going to be essentially sleeping at the wheel right now, not worried about any further easing of monetary policy.
Yeah.
But come later this year, they're going to be really keenly focused on this balance between growth and inflation, and stagflation is very difficult to deal with.
Brutal. BNP Paribas earlier this month put out a note and said comfortably numb. The Fed was comfortably numb. I'm not sure how comfortable they'll be in 1 month's time. Greg, it's good to see you. Thank you, sir.
Always a pleasure.
Greg Dacko there of EY. Coming up next, we'll catch up with Russ Kostrick of BlackRock, Edward Fishman of Columbia University, Steve Major of HSBC, and the former World Bank president, David Malpass. The second hour of Bloomberg Surveillance just around the corner.
Morning. This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
What prompted you to want to get out of just doing surgery to be an administrator and a hospital leader?
Watching others who did it well. I had a dean who recruited me from Birmingham, Alabama to Minneapolis, Minnesota, which is a big jump to convince me to move my family. I realized over time that my training as a surgeon brought a set of credible things to the table. One, if surgeons have a measure of emotional intelligence, not much of our training reinforces that. It reinforces skill, not necessarily emotional intelligence. But if a surgeon has some self-awareness and emotional intelligence, what they bring to the table of leadership are three fundamental things. Number one, they do everything in teams. Their operations, their patients they see is all team focused. Number two, they value process, but they hold themselves very much accountable to execution. They understand that it's good to explore a patient, but what really matters is that you take the tumor out. And then number three, they make difficult decisions on incomplete information. Those things I realized that I could bring to the table as a leader if I had a sort of a passion for working with people and had some sense of self-awareness.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
U.S. tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
I fully expect inflation to be coming back, especially by the second half of this year.
There's this sort of whiff, if you will, of stagflation sort of maybe creeping its way into the narrative as confidence in some areas kind of weaken.
There are some signs that the consumer is downshifting from that strong momentum that we've seen at the end of last year.
We're right now in the midst of what I call a seasonal slowdown.
On a number of different fronts, you can both have, at the same time, higher inflation and weaker growth, which is a definition of stagflation.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
So many equity bulls want to wave goodbye, farewell to the month of February for the equity market. The second hour of Bloomberg Surveillance starts right now with equity futures on the S&P bouncing by just 1/3%. On the Nasdaq 100 up by just 0.2, and the Russell still lower. We're down 0.1%. The next stop for this market 90 minutes from now, 8:30 Eastern Time. PCE data at 8:30. The Fed's preferred read of inflation. That's an important data point later on this morning. The data points for next week to watch, it's not just payrolls, it's trade. We've got to talk about the tariff deadlines. Tuesday, March 4th, 25% tariffs on Canada, on Mexico, an additional 10% on China.
And people are not necessarily taking this as seriously as a number of our guests in the last hour were saying that they ought to, certainly with pricing in the risk, that some of these tariffs could stick. What's notable to me is that you're hearing from the Mexican and Canadian leaders and the negotiators saying, we think we have something that could postpone these tariffs from actually going on. That said, President Trump wants to be taken seriously, and that is the reason why he seems to be doubling down.
It's such a fascinating moment in this market. You've got this real threat. The president doubles down every single day on it. Hardly anyone on this program believes it's going to happen. If it does happen, they don't believe it will stay off. Then we've heard from Jordan Rochester this morning over at Mizuho, who says tariff risks are underpriced. Wells Fargo, a note just dropped from them. This is what they say. Sensory overload. They believe the tariff risk premium in euro-dollar will remain limited until or unless Trump actually implements significant tariffs on the EU, particularly with euro short positions still extended. So everyone's just sitting here, waiting and waiting.
Sensory overload flooding the zone from Jordan Rochester. Manic headline roulette from Goldman Sachs traders this morning. There is a feeling of being deadened by so much information that doesn't have a cohesive thread. It is very difficult for people who seek out narratives. And the only narrative that people are looking to is what you said last hour, which I thought was so smart. The idea that maybe people are going to be scared away by mutually assured destruction and are not going to go through with tariffs that are going to really assert punitive damage. That said, it is unclear, and these have gone on, at least when it comes to China.
The waiting can do damage. And it can do damage to consumer sentiment, consumer activity, can do damage to businesses as well, who otherwise would have hired, would have made investment decisions. That's the stagnation. Deflation is the more curious part of all of this. Do we have to start talking about stagflation a little bit more going into that March 18th, March 19th Fed meeting?
Greg Dacko just on saying that companies will probably pass along about 2/3 of the costs from some of these tariffs to consumers. And I keep going back to a point that Mohamed El-Erian made. The companies have taken price tags baked into the labels off of their products. Remember when you used to go into a store and you'd get a thing of bread at your local Dwayne Reed, and it would say,
deli,
yeah, it would say $2.99.
Say $2.99,
exactly.
and they're charging you $5.
Correct. Well, okay, no, I remember the days when they would charge you $2.99. Now they don't have that tag because they want to be able to be flexible, dynamic pricing in response to whatever trends.
There's places that sell the cans, and it's like, this is from a multi-pack, it is not to be sold separately.
100%.
And they're being sold separately.
Yeah, or like a drink that you know is not the right size to be sold.
Tangent,
privately.
my fault, but I know where you're going.
But anyway, my point is that consumers have PIA and need some, severe remedy to PIA, which we just learned was preemptive inflation anxiety, and are starting to adjust their expectations accordingly.
You can see it in the soft data, that's for sure. Will it bleed into the hard data? We'll see. Payrolls a week today. Coming up this hour, we'll catch up with Russ Kostrick of BlackRock, taking some risk off the table. Edward Fishman of Columbia University as Zelensky heads to the White House, and the former World Bank president, David Malpass, on Trump's latest trade threats. We begin this hour with stocks looking to recover from yesterday's sell-off. Russ Kostrick of BlackRock is making some adjustments, writing, while we are still overweight equities, we have trimmed overall portfolio risk. We expect equities to finish the year higher, supported by strong earnings growth, solid nominal GDP, and moderating inflation. Russ joins us now for more. Russ, welcome to the program. Let's get to the headline. Where are you trimming risk in the portfolio? What have you been doing?
So we've done a bunch of things, but I think they generally all fall under bringing equity risk down a bit. Again, to be clear, we're still overweight stocks. We've moderated that position. And a lot of what we've been doing, we actually started months ago. You remember there's been a rotation going on in the market really since last summer. We still think many of the AI plays, technology, in the long term, these are still themes you want to be exposed to. We have been bringing down that exposure, largely on valuations, and the fact that many of these trades got extremely crowded in the back half of 2024.
So, Russ, one piece of this story where I think you're somewhat contrarian, overweight discretionary. Consumer discretionary has had a tough go of it in February, down 11% on the S&P 500. Consumer sentiment has started to soften. Why do you want to stay in that pocket of this equity market?
It has. But one thing that's probably worth pointing out, is I think a lot of the viewers know, consumer discretionary is a sector that's dominated by a couple of names. And they have had a very tough time, including Tesla. If you look at the broader sector, we actually still like consumer names. And the simple reason is, yes, we see some moderation. Yes, we had a bad retail sales print. But the reality is we have a household sector that's benefiting from an unemployment rate that's still around 4%, very solid jobs growth, strong income growth, and some of the best balance sheets we've seen in decades. So we do think there's a moderation going on. You don't chase names in any price. But overall, the household sector in the U.S. still seems to us like a place you want to be.
How active are you trading right now, Russ, given the fact that there's a whole host of uncertainty, plenty of volatility if you have conviction? Are you, actively getting in and out every single day?
We try to stick with the themes. Again, there's a lot of noise. There's a lot of headline risk, and clearly we've seen that this month. But again, let's take a step back and look at some of the underlying issues that we think are going to drive the markets. Yes, growth is likely to moderate, but we're still in an economy that's growing at or maybe even slightly above trend. In that environment, we think the earnings estimates for 2025, very achievable. This won't be a year like 2023 and 2024. It was all about multiple expansion, but it is a year likely to be driven by earnings. So we're trying to do in the portfolio, keep that risk, maybe a little bit less of it, but keep risk in the sectors and market segments we like, and really emphasize stock selection. I think this is one of the other keys for the year. As we brought down the macro risk, we're trying to lean more into taking idiosyncratic risk in names and themes we think are durable.
Ignore the noise seems to be a theme that I hear a lot from investors that come on the show. We hear it every morning. I'm struggling between ignore the noise and ignore the freight train that's coming straight at you, right? I mean, they're sort of difficult to understand which it is, because on one hand, there are a lot of threats of tariffs. On the other hand, they could potentially get implemented, in which case it could profoundly change valuations and theses. So how do you know which it is?
Well, I'd say a couple things. I mean, one, certainly wouldn't make the case that valuations are cheap. We've already seen a fairly significant adjustment this month alone. The S&P is down 5%. Semis are down 10%. Early growth is down 20%. So you've already had some reasonable adjustment in prices compared to where we were just a few weeks ago. In terms of the policy, obviously, we're all trying to figure this out. Again, I think the lens you want to view this through is economic growth. If you believe, as we do, that growth is going to remain solid, and off of the back of that growth, you're going to get a decent season for earnings, then I still think you want to stay long equity risk. Again, maybe not to the extent you were back in July of last year, but unless you think we're going into a much deeper slowdown, and as a result, earnings estimates are unattainable, I still think there's a case for ending the year with a decent return to equities.
Do you believe these tariffs go on?
I believe tariffs. Look, I think, like you, Jonathan, we're all trying to figure out what's going to happen. I do think you're likely to see tariffs. The question is, we don't yet know the magnitude. We don't know the breadth. We don't know the timing. So this is obviously what's upsetting markets, that with that uncertainty, the impact on growth, where it's going to hit, what countries, that's still something that investors are trying to figure out.
Sure. Well, I'm just trying to figure out how trade dependent your call actually is. If you end up with 25% tariffs on Mexico and Canada, an additional 10% on China, if we spoke to you the day after, does your call change?
So look, I think obviously tariffs impact the economy, and they certainly impact the traded goods sector. So that's something you've got to be cognizant of. But there is another point here to bring up. This is much more of a service-led economy than it was 30 or 40 or even 20 years ago. And when you think about the last year or two, what drove the economy? It wasn't that surge in goods that we saw in the pandemic, in the aftermath of the pandemic. It was the service economy. Again, we can joke, call it the Taylor Swift economy. It was driven by experiences, entertainment. Those are not parts of the consumer space that are subject to tariffs.
At the same time, it really raises the question about whether Donald Trump will respond to potential weakness on the heels of preemptive inflation anxiety or whatever else comes around tariffs, and will essentially hold back if it starts to become too painful. How much is that almost baked in to your call that there will ultimately be some sort of response from the White House if things get carried away in terms of a sell-off?
Look, it's very hard to discount how investors are handicapping this. It's fairly unprecedented. But again, I would say that when we say, is it not baked in? We've already gone through a pretty decent correction in large parts of the equity market, particularly those parts, as you pointed out, consumers that led last year, a lot of the AI space. And again, part of what we're seeing, it's not just about policy. There's also been a pretty obvious mean reversion trade. And if you look at what's worked so far year to date, defensive companies, healthcare. Yes, these are places you might want to be if you're worried about tariffs. But another characteristic we have is these were areas that lagged significantly in 2024. So part of what I think is going on is not just about policy, it's about investors rotating into some of last year's laggards.
Russ, appreciate your input as always. Looking forward to next week and seeing what policy changes we might or might not get. Russ Kostrick there of BlackRock. Look, sometimes to make sure people stay fearful of the bark, you've got to bite. And there's a lot of things on the table next month. We could see some bites. 25% on steel and aluminum. I think a lot of people would say out of the three, that's probably going to be a yes. Reciprocal tariffs, Europe, in a firing line, without a doubt. 25% on Mexico and Canada. Just feels still like, to many people that come on this program, a stretch, which is why it's so dangerous going into next week. That is the overwhelming consensus position. That is where there is the most scope for surprise.
That is incredibly well said. Tom Narayan came on the show a couple of weeks ago, and he's on our show later this morning, and he talked about negative infinity and why price in negative infinity if it's something that's unpriceable for some of the U.S. auto manufacturers. So negative infinity is not being priced in. At the same time, if that's your bite, how much does this market alarmingly respond?
BlackRock, Federated, I'm thinking of Steve Orth earlier this week with us. They just view trade as one piece of a bigger policy mix, and the overall policy mix is still pro-growth, pro-risk, and in 12 months' time, when we look back 12 months, that will be the conclusion for a lot of people in this equity market.
And that seems to be what a lot of people who are more bullish in the market believe. As Peter Scheer said, there are two diametrically opposed outcomes. You could have a really good outcome where people bring back some of the dynamism to the United States. You could have a really bad outcome where you end up with a trade war and stagflation. And how do you price in between? And this market's trying to, and really just exhausted.
The journey's a difficult one. Equity futures right now on the S&P 500 just about positive by 0.25%. With an update on stories elsewhere this morning with your Bloomberg Brief is Danny Berger. Hey, Danny.
Hey, John. China vowed to take, quote, all necessary measures after President Trump unveiled an additional 10% tariff on the country that would take effect on Tuesday. Sources tell Bloomberg the new measures took both U.S. and Chinese officials by surprise. Neither knew the additional tariffs were coming. Elsewhere, Tencent is joining the AI model race. It unveiled a new model designed to respond as instantly and as possible that differs from DeepSeek, which uses a deep reasoning approach. Tencent said that the deployment costs have fallen sharply. They join OpenAI and Alibaba, rolling out new AI models at a rapid pace. Now check on HP shares. They are trading lower by 2.7% in the pre-market trade. It said that rising component costs and tariffs on Chinese goods will impact profits. HP also shared that it will cut between 1,000 and 2,000 workers, saving roughly $300 million per year. That's your Bloomberg Brief. John.
Hey, Danny, thank you. More from Danny in 30 minutes. Up next on the program, President Zelensky goes to Washington.
I think we're going to have a very good meeting. We're going to get along really well. Okay? We have a lot of respect. I have a lot of respect for him. I believe we're going to get it done, and I think it will be very important, very historic, and we're going to save a lot of lives.
Up next on the program, Anne-Marie in Washington, D.C., plus Edward Fishman of Columbia University joining us in New York next. Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television. Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg. Bloomberg brings you breaking news 24 hours a day, powered by 2,900 journalists and analysts in more than 150 offices across the globe. Bloomberg Television. Context changes everything.
Equity futures on the S&P 500 positive here by 0.2%. In 1 hour and 13 minutes, the main data point of the morning, 8:30 Eastern Time, PCE, core PCE, the Fed's preferred read of inflation. That's the next stop for the bond market. Yields just about unchanged, the 10-year 4.2539. And the surveillance this morning, President Zelensky goes to Washington.
I think we're going to have a very good meeting. We're going to get along really well, okay? We have a lot of respect. I have a lot of respect for them. We've given them a lot of equipment and a lot of money, but they have fought very bravely, no matter how you figure. They have really fought. Somebody has to use that equipment, and they have been very brave in that sense. I think we've come a long way. I believe we're going to get it done. I wouldn't say that if I didn't think so. And I think it will be very important, very historic, and we're going to save a lot of lives.
So here's the latest. Trump softening his tone on Ukraine ahead of his meeting with the President, Volodymyr Zelensky, this morning. Zelensky is expected to sign a mineral deal with the United States in an effort to end its war with Russia. Anne-Marie joins us now from Washington, D.C. with more. Anne-Marie, describe what the next few hours will look like in Washington.
Well, for Volodymyr Zelensky, Jonathan, this is probably the most important meeting he will have with a U.S. president in his political career, given the fact that last week President Trump had called him a dictator. And you saw this acrimony really playing out in the press. We heard a little bit about it from our interview with the Treasury Secretary, Scott Bessent, who was the first one to introduce this mineral deal in Kyiv to Zelensky. But right now, what you have is a bit of a softening of a tone. You heard there from the president that they're going to be signing this mineral deal. For them, this is really the start of potentially a closer alliance between Trump 2.0 and Zelensky. What Zelensky wants this to be is potentially the start of security agreements. I will note, reading between the lines with the president's comments yesterday, besides the fact that he did say to a reporter, did I call him a dictator last week? I don't remember. He said that this minerals deal means workers are in Ukraine, and it's a backstop, you can say, because U.S. workers would be there.
Anne-Marie, down in Washington, D.C. More from AMH later on this hour. She'll be catching up with David Malpass, the former World Bank president, in about 30 minutes from now, so look out for that. Let's extend the conversation with Edward Fishman, the professor at Columbia University and the author of the book Choke Points, American Power in the Age of Economic Warfare. Joins us now for more. Eddie, it's good to see you, sir. Also the former Russia and Europe lead in the State Department, Office of Economic Sanctions Policy. Let's build on some of that. What's at stake today for Ukraine?
I would agree with Anne-Marie. I think this meeting is the most important of Zelensky's political career. And I think it's probably his last chance to try to pull Trump back from the brink. In the last 2 weeks, the Trump administration has been drifting dangerously close to Moscow. You've seen extended conversations between Trump and Putin, between Steve Witkoff and Putin in the Kremlin, long meetings between Rubio and Foreign Minister Lavrov. You haven't seen anything like that in terms of engagement with Ukraine. The engagement with the Ukrainian government's been happening at a much lower level. So I think Zelensky, his real goal today, even more than signing this minerals deal, is just getting some face time with Trump and trying to persuade him that it's in America's interest to continue backing Ukraine.
How much is it crucial for him to get some sort of economic tie between the two countries, especially if that economic tie includes resources in land that's already been claimed by Russia?
I think it's critical. And look, Zelensky is a very smart politician. He understands that we're living in an age of economic warfare right now, and that China is weaponizing things like critical minerals against the United States, and that we're extremely vulnerable to Chinese economic warfare. And so what he's doing is he's trying to couch support for Ukraine to Trump saying that it's in America's own interest vis-a-vis China and for its own economic interests. And I think this is speaking to Trump in a way that appeals to liberal order or America's alliances don't really work with Trump.
Is there a historical analog to how much some of these trade relationships are changing from these are our friends to a more mercenary approach of what are you giving us and how much does that really affect us in a way that makes us want to help you?
Look, I think there is some, unfortunately, scary echoes I hear from the 1930s. It was the last sort of time we saw the breakdown of global trade relations after sort of the Great Depression, the Smoot-Hawley tariff, which went into effect right after the Great Depression in 1930. That's when you started to see states really worry that they couldn't secure markets through open trade, right? And so you see things like Hitler deciding that he needs Lebensraum because he needs to acquire territory and resources to control them as opposed to just trade for them. So I do worry that in a world where you don't feel like you can just freely trade and invest in other countries, the temptation for things like invasion or conquest actually goes up quite a bit.
Wasn't that Merkel's theory with regards to Putin? And that didn't work out. So what's the lesson of the last 20 years?
So I think what Merkel got wrong, so it's a very good point, John. What Merkel got wrong was that she wanted to make Europe 100% dependent on Russian natural gas, right? And that's what, if they built Nord Stream 2 and doubled the capacity of pipeline gas from Russia to Germany, that would have made, put basically Germany at a complete, Damocles sword that Putin was holding over their head. So I think Merkel's mistake was to say we need to be completely dependent on Russia just because this cheap gas is important for our industry. What you do need is interdependence in a more broad way, right? More diversified interdependence. What Merkel was doing is basically handing Putin a choke point that Putin could weaponize against Europe, which he indeed did in 2022 when he cut off European access to natural gas.
After President Trump warned them repeatedly in his first term on some of these issues, I want to believe that this could be a force for good, that maybe the outcomes could be positive. Can we see things that way?
I do. I'm cautiously optimistic that if this mineral deal gets signed and Trump sort of moves back from sort of this very pro-Putin drift that he's had over the last 2 weeks, I think we actually could wind up being in a better place on Ukraine. Because if you do have American companies deeply invested in Ukraine's critical mineral resources, not just for their own financial gain, but again, critically, for America's position in the age of economic warfare that I talk about in my book. Because without access to critical minerals from places like Ukraine, we are at the mercy of Beijing. So I think that this could be a masterstroke. John, some people have talked about, is Putin trying to pull, or is Trump trying to pull a reverse Nixon and sort of go to Russia to split off China? What I actually think could happen, is more plausible, is maybe Trump could go to Ukraine to try to sideline China and Russia from their critical mineral dominance.
What would you have to hear today to think that this is more of a stroke of genius and less a warning shot?
I think we'll know a lot during the joint press conference at 1 p.m. Because again, I do think this mineral deal is going to be signed, right? I mean, it's been telegraphed that this is going to happen. So if it's not signed, that'd be a very bad signal. What I'm really looking for is what is the tone that President Trump strikes when he's up there with Zelensky? Because as we've seen a week ago, he's calling Zelensky a dictator, saying that he has to leave the country. He softened his tone yesterday when he was meeting with Keir Starmer in the White House. So if he has a much more friendly tone towards Zelensky today, we know that maybe the Ukrainian former comedian worked his charm.
Just more broadly, given the fact that you did write this book about the age of economic warfare, how do you understand the ultimate goal of some of these tariffs and some of these rearranging of geopolitical relationships?
Look, I think that there's a structural underpinning of all this, right? It's not just that Trump is a tariff man. And, we can't just say that this is all Trump who's causing it. We're still living in a global economy that's designed for this benign geopolitical environment of the 90s, the halcyon days, where we thought economic relations were win-win. The sheer fact right now is they're not, right? I mean, economic relations between the U.S. and China are not win-win. Between the U.S. and Russia, they're certainly not win-win, and they haven't been for a very long period of time. The U.S. is not the only country that feels this way. China feels this way. That's why they've spent hundreds of billions of dollars in domestic self-sufficiency. Europe feels this way. Japan feels this way. So I think what we're moving toward is an unraveling of interdependence. The big question is, do we move toward a world where there's sort of a democratic bloc on one side and an authoritarian bloc on the other? Or is it one that's more like autarky, where everyone's just trying to invest in their own countries and doesn't feel confident doing anything overseas?
Some major questions that we need to answer over the next few decades. Edward, it's good to see you.
Great to be back.
Congratulations again, once again on the book. Edward Fishman there of Columbia University, the author of the book Choke Points, American Power in the Age of Economic Warfare. Up next on the program, Steve Major of HSBC on a rip-roaring bond market rally, 7 consecutive weeks of lower yields on a 10-year maturity. Equity struggling to bounce this morning. Equity futures up by 0.25% as we head towards another week of losses on the S&P 500.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onim, only on Bloomberg.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
2 hours away from the opening bell, equity futures here positive by 0.25%. A bounce back on the Nasdaq. The Nasdaq's down hard for the month, down by more than 4% so far in February. The Russell is down by more than 6 percentage points so far in the month of February. This morning, no bounce at all. We're negative another 1/10%. With 2 hours until the cash open, let's get you some morning movers. Here's Yahara Hacker. Say, Yahara.
Hi, John. We start with Dell, lower here in the pre-market, down nearly 4%. That's because Dell says the high cost of NVIDIA chips will hit its gross margins for the fiscal year. They're predicting a 1 percentage point decline from a year earlier. That overshadowing what was otherwise a strong outlook from Dell. For the fiscal year, it expects to ship $15 billion worth of AI servers, which represents a 50% jump from a year earlier. Next up, we have another tech stock that disappointed, and that is HP. It's down 2.8% right now. The PC maker saying that rising component costs and tariffs on items they get from China will weigh on profits. But even then, analysts over at Morgan Stanley think HP's guidance feels ambitious at a time when they're still seeing market uncertainties in PC. Next up, we have Monster Beverage, and that is up 2% here after beating in the fourth quarter. Margins came in better than expected, and part of that is because Monster was able to implement price hikes on some of its products, which is interesting at a time when we know the consumer has become more sensitive to pricing. But for Monster, it's working for now. John?
Yahara, thank you. More from Yahara a little bit later this morning. On our radar this morning, President Donald Trump confirming that 25% tariffs on Canada, on Mexico, are set to go into place on Tuesday. Trump saying that drugs from the two countries are still entering the United States at very high and unacceptable levels.
We were talking with Russ Kostrich earlier, and he said you have to ignore the noise and look at the bigger ideas, and you have to wonder, is it ignoring the noise or is it ignoring the freight trade at a time where potentially this could be really damaging to valuations, and most analysts think the market is not pricing this in.
Have we had the growth scare? We've seen the move in bond yields. We've had a move in discretionary stocks. Most people would point out that Tesla's a big chunk of that, and they're right to point that out. This is what Neil Dutta just wrote in just moments ago from Renmac. He echoed something you said earlier in the program. How can it be a growth scare when Europe keeps outperforming and much of the sell-off in US stocks is in momentum stocks? We've seen this big move in tech names. Goes on to say this is not the growth scare part of the sell-off, which means there's more downside still to come.
The real declines that I have taken note of was yesterday, NVIDIA down more than 8%. When you take a look at the Magnificent Seven stocks, they are down more than 13% from their peak in December. This has driven a lot of the declines. You look at Bitcoin, you look at some of the other momentum-type names that had really benefited since Donald Trump's inauguration. A question here of what's going on. Is this just an unwind, something has to do with valuation, or is this really a growth scare? Is it tied to tariffs? And to Neil's point, if we get negative economic data, how much more could you see down?
Payrolls a week away today. Need to talk about China as well. President Donald Trump also calling for an additional 10% tariff on China, set to go into effect also on Tuesday. Chinese stocks taking a big hit overnight, with the Hang Seng China Enterprises Index sliding the most since October.
So to me, the reason why this matters is because, first of all, as Anne-Marie points out quite a bit, Chinese tariffs on Chinese goods are the ones that have stuck. The others have been threats that have been walked back. That is notable. An additional 10% tariff is significant, especially given that this is a different scenario. But the second thing is the rhetoric coming from Chinese officials was, we will retaliate. And if you end up putting an additional 10% fee on some of those goods, you might end up with a trade war that a lot of people think has been off the table.
Not everyone can pull a Starmer, can they? Turn up to the Oval Office with an invitation from the king, knowing that the president loves the king and the president also loves the United Kingdom.
No, right now, this president does not love the Communist Party of China in the same kind of way that he seems to really appreciate the royalty.
And I think a state visit to Beijing is maybe not something he's too interested in.
I can't imagine that that would ever happen. But
who knows? Hey, who knows?
Yeah, I mean, can you imagine? He wanted a military parade, so maybe he will get one.
Who knows? Let's turn to this story. A federal judge ordering the Trump administration to pause mass firings of some government employees. The judge saying the Office of Personnel Management's order directing agencies to fire probationary employees is, quote, illegal.
So this to me was interesting for a couple of reasons. First of all, a lot of the cuts have been tied up in the court system. The Trump administration has gotten a lot of wins. Let's just make that very clear. A lot of judges have signed off and said that absolutely the DOJ can go in there and do what they're doing and that these cuts do make sense. There is a question, and this is the fundamental fear that a lot of people have. If you get a battle between the court system and legacy judges that were appointed by Democratic presidents, do you end up with some sort of fear that the administration won't comply, or how do you get around it? There are some real questions that come into the fore, and I'm more interested in that than, say, this particular ruling.
I'm more interested in whether the government will comply when the president makes an order to do something. Will we get what many people are describing as malicious compliance, where they make things seem a lot worse than maybe they actually would be?
Well, you could take that a step further, and you could say, who is the government? I mean, just if you want to go there, in the sense that it goes to the whole judicial versus executive power, right? If the judge is signing off, I hear what you're saying, and it's sort of another point about whether maybe there are complaints about how dysfunctional things are getting as a result of people not being there. Are we getting reliable reports?
Sure.
It goes into all of this kind of
People might use the phrase deep state. I'm not going to use that phrase. I'm just going to say that when an institution is that big, the institution pushes back and makes it very difficult to achieve the kind of things that you're trying to achieve.
And I think this is the reason why a lot of people say, look, first of all, Doge has been very popular. The idea of making cuts and being efficient has been very popular.
With the public, massively popular.
The second thing is, do it in a way where there is a predictable type of methodology that people can understand. And I think that that really is what people are looking for. There are a lot of details to this.
A lot of details we can talk about over the next year or so. Let's talk about the bond market. Lisa's favourite, the 10-year government bond yield is lower on this week for a 7th consecutive week, the longest streak in more than 5 years. Steve Major of HSBC, good friend of this program, good friend of ours, joined us here in New York. Steve, it's good to see you.
Good morning.
What's behind that rally of almost 2 months on 10-year government bond yields?
I think you touched on some of it in the preamble. Can I call it a preamble?
You can call it the preamble, the setup, the appetizer for this, the main course.
The BS session.
As you teed it up, yeah. So how do you disaggregate this bond rally? Because it probably started with something really simple. It could be the market was just too cheap. So there's a valuation angle, and you can see it in swap spreads. You can see it in US bond yields versus the rest of the world. You can see it in real yields being above 2, all that kind of thing. So maybe point 1, it was just too cheap. And then you get some trigger events, or you get something that starts to spark it. And I think maybe there was a bit more confidence in the fiscal position. And so I think you mentioned Doge, that could be key. In between the date of the election back in November and the inauguration, I think markets were also sensing the regulatory shift, which meant there could have been some pre-positioning which was more favorable towards treasuries. Now, that was coming in the treasuries versus swaps spread, right? So there's a bunch of things that were happening. You talked about 7 weeks of bond rally. I think it's been helped by some of the forward-looking data. So Atlanta Fed, GDP now, some of the survey data. Think about what's going to happen to confidence when uncertainty goes up. So uncertainty is not volatility. Uncertainty in the real world, in the real economy, means people sit on their hands and they don't do stuff. It means that investments aren't made, decisions aren't made, and that's not good for growth. Uncertainty in markets normally means there's a big dispersion in opinion about what's going to happen. But I think in the real world, it's actually consistent with the surveys softening ahead of the real data.
It's completely against the grain compared to where we were at the end of last year. And that's what's intriguing for us on this program. At the end of last year, when Donald Trump won the presidency, we saw curves steepen and yields push higher at the long end of the curve. And people were talking about things like tax cuts, more issuance, heavier supply still to come. Have we just parked that story? Can we ignore that story?
Again, positioning is important. We came into the year with the consensus position, and the position being a bearish steepening of the curve, inflation, fiscal, blah, blah, blah. I did an interview with Manas at the start of the year, and I said, I'm not meeting any bomb balls. That's because there weren't any, right? So once you get a bit of momentum, then people become a bit more confident. And it's a bit scary, the recency bias in these markets, in that people do like a bit of momentum. And so I think the first move was positioning and the consensus, and then some trigger points. And now for this rally to be continued, for it to be sustained, you're going to have to get something in the data. You mentioned payrolls, but it's real economy data. So the economy is kind of being retrofitted to where the Fed already took rates. Does that make sense? Right. The idea that maybe they cut too much, at the time, nobody was really saying it, but at the time, it seemed that they were cutting into a window where there was an opportunity to cut. And then, of course, bond yields went up a lot, even though policy rates had come down 100 basis points. So something was wrong. So the bond market is moving back into line, but really the economy has to be fitted to where the policy rates are as well. So there's a lot of this going on that I think explains the bond rally move. And we can get through 4% on the 10s in the next few weeks with this momentum continuing. If we're talking about 10 weeks of bond rally in 3 weeks' time, we'll be through 4.
Okay, so basically what I'm hearing from you is that if we get some weaker economic data, we could see this bond rally accelerate where you get the 10-year below 4% and the idea of real growth concerns bleeding through the entire Treasury space.
Yeah.
How much do you buy the idea that this bond market and this Federal Reserve is going to be constrained by stagflationary fears, stagflation light, et cetera? How much does policy play into this?
You're quite right, Lisa, to qualify it with stagflation light, because you know that pure stagflation requires recession and accelerating inflation. We're nowhere near either of those at the moment, so you're quite right to qualify that. It strikes me that inflation between 2 and 3 is not a problem for anyone, and it's probably part of what's really desired, because there's too much debt, and the process of dissolving the debt requires inflation to be a touch over target. I don't think anyone's going to worry about 2 to 3 on inflation. The Fed's already pivoted to a growth focus. They did that last year. And now we're seeing validation of that pivot. So as I said, the economy needs to fit to where the path of lower rates needs it to be. That may sound like a reverse in the causality, but this sometimes is how it works, right? So I'm not that worried about inflation. And your famous last words, but
I think that you're not that worried about inflation, but Fed officials are, and they're talking about the potential for having to choose, having to weigh the two evils of whether inflation is sticky or even accelerating modestly, and some sort of downside to growth.
Yeah.
As bond investors, how do you grapple with it?
It's fair what you said. It is part of their job. And there are some in the Fed who don't completely worry about inflation so much, right? So that you have a range of views, just like in any central bank. The fiscal policy, I think, is dominant. You've heard of fiscal dominance. For the bond yield to be at the right level for the fiscal policy, it needs to be at 4% or below. The CBO, the budget office, is budgeting 4.10 on the 10-year. Now, back in September, we were at 3.6 almost, so it was nicely inside. So to be able to afford this level of debt with the interest payments that come from it, we need the yields below 4. So I think that by having a fiscally responsible treasury set up and the expense cuts coming through and the economy cooling, you haven't got to worry about inflation so much, Lisa. I think it is their job to be a bit hawkish on inflation, but I don't really think it's a problem.
I'll ask a simple question, which requires a very thoughtful answer, and I know you've given it some thought. Does the supply matter?
No. Next question.
Why not?
Right. So I have this conversation every day of the week with clients, right? And you think about from a trader's perspective, it does matter because they've got to take down all this supply and auctions and syndications, and so there's a concession around the supply. That should not be confused. That concession around the supply should not be confused with a strategic view, because the bond yield is a function of today's policy rate and expectations for that policy rate where it ends up in the future, right? And it strikes me that it could be a double counting on the yields if we start adding too much additional term premium to what's already in the price. So if the Federal Reserve thinks that the deficit's a problem and is causing inflation, then they're not going to cut rates. They might even be hiking them, right? But if the Federal Reserve thinks this economy is cooling down and the stock of the debt and the interest payments are weighing on future growth, and in fact there's a path to lower rates in the second half of the year, they are cutting into along that path, right? So it just strikes me that it's very dangerous to say, oh, there's a lot of supply, the yield goes up, because there's no empirical evidence for that. Look what's going on in China and Japan, and also look at the bond yield, which is above 4%. It's around 4.25. The policy rate is 4.25, 4.50. Right? It doesn't strike me that there's a lot wrong with a bond yield that reflects the view that the policy rate is going to stay unchanged for quite a long time. If you change that view to the fact that the Fed is back on the path of lower rates, the bond yield should come down. right? But I don't know, there's this intuition that the supply matters. It's informed by the auctions and the syndications and the concessions that the dealing rooms have to take into account, right? But not to be confused with a strategic view on where bond yields will be.
Steve, I knew that would provoke a big response. Eventually. Steve Major of HSBC. Steve, it's good to see you, as always.
Likewise.
Thank you, my friend. Appreciate it very much. The 10-year at the moment, yields lower by 2 basis points on a 10-year. About 4.24 at the moment. Keeping one eye on NVIDIA this morning, rolling over. Now negative in the pre-market. We're down by more than 1.7%. Let's get you an update on stories elsewhere with your Bloomberg brief. Here's Danny Berger. Hey, Danny.
Hey, John. Canadian politician Doug Ford won a third straight election to lead the province of Ontario. Ford campaigned on the promise to protect Ontario's economy from President Trump's trade policies, threatening retaliation if the U.S. imposes tariffs. U.S. tariffs on China are scheduled to begin on Tuesday. Netflix is considering moving from its Hollywood location when its lease ends in 2031. Sources tell Bloomberg one option includes buying the landlord's interests in the buildings. Netflix's corporate headquarters, is in Northern California, but several of the company's senior leaders, including the CEO, live in Los Angeles. Elsewhere, Citi accidentally credited $81 trillion to a customer's account instead of $280 last April. The Financial Times reports that the bank reversed the transactions hours after. It contains echoes of when Citi accidentally sent $900 million to a group of creditors 5 years ago, since which Citi has continued to fix its operational issues. And that's your brief, John.
Danny, thank you. More from Danny in about 30 minutes. Up next on the program, Trump, the deal maker.
Mr. President, did our Prime Minister persuade you not to put tariffs on the UK?
He tried. He was working hard, I'll tell you that. I think we could very well end up with a real trade deal where the tariffs wouldn't be necessary.
That conversation just around the corner with the former World Bank President David Malpass joining Anne-Marie in Washington, D.C. From New York, this is Bloomberg.
I've seen firsthand how some fashion businesses make women feel. And I think there's one thing, you know, being really vocal and being an Instagram activist and talking about something, there's a difference than putting your money where your mouth is and really trying to do something about the problem. And that's what I did with that business. It was about how do I take everything that I know and I've learned and actually do the opposite. And I think that as a young black female entrepreneur, the only thing that I could do was what I know from my experience. And the honest truth is, I didn't set out to create a company that was like deeply rooted in the principles of inclusivity and diversity. I set out to make a company that was right for me and my friends, and I knew that if I had a problem, chances are somebody else does. And I think that's where so many businesses are, you know, created, when you're solving a problem that's real for you and therefore real for the consumer.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. markets close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Middle East, and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Bringing you up-to-the-minute tech news whenever and wherever it happens. I'm Ed Ludlow in Las Vegas, and this is Bloomberg.
Equity futures still just about positive here, positive by 0.25%. Just one eye on Nvidia throughout this morning. That stock got slammed yesterday. No bounce this morning. It's down 1% in the pre-market, down 1.1% in early trading. Under surveillance this morning, Trump, the deal maker.
Mr. President, did our Prime Minister persuade you not to put tariffs on the UK?
He tried. He was working hard, I'll tell you that. I think we could very well end up with a real trade deal where the tariffs wouldn't be necessary. I think we, in all fairness, in all seriousness, I think we have a very good chance at arriving at a very good deal.
So here's the latest this morning. President Trump saying he will restart negotiations on trade with the UK after meeting with British Prime Minister Keir Starmer. The president suggesting a deal could happen very quickly. Anne-Marie joins us now in Washington with a special guest. Hey, Anne-Marie.
Good morning, John. That's right. I'm joined with a friend of the show, David Malpass. He's the former head of the World Bank. Of course, he was the head of the bank when Trump was in office in 2019. David, thank you so much for joining us. So we were talking about all morning this trade anxiety really going into the weekend because Trump yesterday said that when it comes to the pause on Canada and Mexico, that 25%, those tariffs will go through. And then he added an additional 10% on China. How should we be reading this?
A big change in the direction of trade, but then the trading system wasn't working, and so.
But you think those tariffs hold for Tuesday?
I think this time the tariffs will hold, but that also begins this process of trying to adjust the whole global trading system into one that works better and specifically better for the U.S. This is going to quickly, I think, get into intellectual property rights and the other trading practices that China's been involved in. Also, transshipment and the issues of backdoors into the United States with trade. So I think those will go on for months.
And we already know those conversations are happening in terms of the backdoor between Mexico and China. Almost 60% of U.S. adults, though, Bloomberg did a survey with Harris poll, almost 60% of U.S. adults expect Trump's tariffs will lead to higher prices. How concerned are you about this stoking inflation and potentially stagflationary fears creeping into this economy?
Products are going up and down all the time, so some products will go up. But then the question is, what does the U.S. economy, this amazing economy that we have, what does it do to react? And I think there will be a huge rush by U.S. companies to make things in the U.S. and also to find other sources. They're already doing that. Companies are preparing. They've known this is coming. There's been some preparation time, and so they'll make adjustments. And that will create jobs in new areas, which is the point. On net, you get that plus the bigger changes that President Trump is doing is on the regulatory side, on the tax side. Those are positive for output in the U.S. One of the important spots is energy, and I think there really will be a lot more energy produced by the U.S., which also is stimulative for growth.
So you see the economy right now in a good place. So do you think the Fed then should be on hold for the rest of the year?
I would like to see a lower yield curve across the board. That's on the short end and the long end. And I think to do that, you have to exude confidence in the U.S. dollar and in your ability to control your spending. That wasn't being done in the previous administration. So there are opportunities now to get a lower yield curve across the board. They're not embarked on that yet. It's maybe a little early, but
well, we know the Treasury Secretary said he wants a lower 10-year yield, and that seems to be a key point in the markets that this administration is watching. What do you think they want to see, and how can they achieve it?
Stick with the eye on the prize, that is abundance, and you want common sense. If you really apply those two things, you will get a lower yield curve. That's because the U.S. economy is so strong. What we're talking about with Treasury rates, both short end and to an extent long end, is your confidence in your ability to pay and to pay on that and be consistent. And the U.S. can up that. These are supposed to be the riskless rates, so they can be lower if you create confidence within the economy and within the dollar.
So you think the Fed should be cutting into a good economy?
We can hope that the deregulation is implemented, the energy production is implemented, and the Fed will have an opportunity to be cutting into a deregulating, faster growing, more efficient economy. Yes.
We have seen with the Doge effect, President Slash take the U.S. out of the WHO, U.S. aid commitments. You used to run the World Bank. Do you think the World Bank is next?
I think there'll be a look at all of the international organizations. What is the U.S. getting for them? What's the governance structure of them? And are they doing work that's actually necessary for governments to be doing? One challenge for the IMF and the World Bank is they were created in 1944. So you can imagine that their mission has grown vague, that they're older. They served the purpose that they were originally set up to. So one of the challenges for all these organizations is to stay small and stay on mission, and I think that needs to be done.
David, thanks so much for your time this morning. Jonathan, of course, the former head of the World Bank under Trump 1.0, David Malpass, ending there that potentially IMF, World Bank may be next when it comes to how much the U.S. might support them. Anne-Marie, appreciate the update. Anne-Marie there down in Washington, D.C. Your equity market's shaping up as follows. We're just about positive by 0.25%. PCE data, the latest read on inflation, about 34 minutes away. Coming up in the third hour of Bloomberg Surveillance, Tracy McMillan of Wells Fargo, Tom Narayan of RBC, Andrew Honhorst of Citi, and Michael Kushma of Morgan Stanley.
What legacy I would love to leave is to make sure that in my village I have infrastructure. So long when I'm gone, things are still working, then I have done my job. And if some people get inspired through my work and then try to engage themselves for their community and create something that is inspiring for everyone, I will be happy.
What's the best piece of advice you would give to someone young who wants to make a difference actually in this world? In architecture or with something else?
Wow, I'm not the right one to just do that.
I think you are.
Yeah, but with the pressure you have, and then you try to be the good one, the fancy guy, the intellectual one, I have no advice than to believe in yourself and really work hard. You know, when I started, no one would have imagined that I will be able to see my name connected with Aga Khan or Pritzker or sitting at Bloomberg to talk about sustainability, about future of sales. No, myself 5 years ago, if you told me that, I will say no. I will never imagine. So I will encourage everyone to believe in what you're doing and not try to run after the newest of the newest. Just be consistent. Just work on things that matters for you. Really, at the long term, it pays.
From the beating heart of global finance, economics and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
What about artificial intelligence? Is artificial intelligence going to enable you and others to say, we have enough information to know exactly what something is going to be worth in terms of insuring it or not?
Artificial intelligence is finding its way into our business in a variety of different factors. I think the first piece is getting much better insight into data, which allows us to make better decisions on underwriting. It's also a great opportunity to service business better in terms of like call centers and different ways of what's using robotics and other AI will be very helpful. But it is an emerging practice within the industry and one that is evolving very quickly. So it's also going to present risks that other companies, how they use it and how they use large language models and making sure the decision making is very sound. So it's complicated, but it definitely is benefiting the business today.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
The big picture hasn't changed yet. The market is concerned about growth.
A key pillar of this bull market has been the resilience of corporate earnings.
We've struggled here domestically to kind of meet the bar of high valuation.
The broadening out of earnings later this year among the S&P 493 is really the most important question to watch.
The level of concentration is dangerous. You look back in history at times when we've been even remotely close to this, it's ended badly.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Heading towards a second week of losses on the S&P 500, staring down the prospect of the biggest weekly loss going back to September of last year. In the equity market right now, equity futures at the moment just about positive, up by 0.2%, barely positive on the Nasdaq 100. Nvidia in the last 30 minutes turning negative in the pre-market. Coming up a little bit later this morning, 8:30 Eastern Time, core PCE, the Fed's preferred read on inflation.
And it comes at a time where suddenly people are talking about the idea of stagflation, fears of slower growth ahead while potentially sticky inflation remains. I'm wondering whether we're still data dependent. Are we in a regime where we're actually looking at this data and going to trade off of it? Or are we narrative dependent, saying just wait, as a number of analysts came on and said, some of these policies might be disinflationary now, but inflationary later, or vice versa?
I would say we're headline dependent, and these are the latest headlines. 25% tariffs on Canada and Mexico going through on Tuesday, apparently, and an additional 10% on China. That was shaking up a market already shaken up.
So this is also another question, just to add to sort of the headline roulette that Goldman Sachs was talking about. How much is it shaking up markets? Are we seeing the real threat of tariffs getting baked into valuations across the board? Sure, you saw more than a 1.5% pullback in General Motors and Ford shares yesterday, but not necessarily getting priced in to the degree that you would expect if they actually were going through. So it raises a question. Can you ignore this, or is this something that could potentially have a much bigger bite than people expect?
Has it hit markets? It's a good question. And foreign exchange? Hard to make the case that it has. The Mexican peso, the Canadian loonie, so far in this month, just about positive. For the month of February, for the equity market, nil data, Renmark out this morning already suggesting for the equity market, if you believe there was a real growth scare right now, on the back of these tariff headlines, why would Europe be outperforming? Does that make sense to you?
Why would Nvidia be the biggest underperformer after delivering better than expected earnings? Why would Bitcoin be selling off to the degree that it is? This is a momentum unwind, and that's what we heard Cameron Dawson lead off the show saying. This is essentially people retracing some of the steps and leading to levels that we saw right before the election. For it to take a leg further, to Neil Dutta's point, you'd have to see a real economic weakness. Core PCE isn't going to be it. Payrolls, definitely more important to watch.
Payrolls a week today where there is a trend. 7 consecutive weeks of lower 10-year bond yields. Phenomenal. Longest weekly run going all the way back to the summer of 2019, June 2019 to be precise. Yields this morning just about unchanged. The 10-year 426. Coming up this hour, over the next 60 minutes, we'll catch up with Tracy McMillan of Wells Fargo, with equities struggling to bounce, Tom Narayan of RBC on how big tariffs will hit the auto sector, and Andrew Honhorst of Citi with inflation data less than 30 minutes away. We begin this hour with stocks heading towards the biggest weekly loss of the year so far. Tracy McMillan of Wells Fargo is still constructive, writing tariffs portend an ongoing noisy and confusing backdrop for investors. Still, we think broader risk opportunities will develop during the year and foresee higher U.S. equity prices by year-end. Tracy joins us now for more. Tracy, welcome to the program. Give us some of that optimism. What takes stocks higher towards year-end?
Thank you, Don. Yes, so what we think takes stocks higher by year-end is earnings growth. We did have a very interesting earnings season here for the fourth quarter earnings. And what we saw was that over the last 4 weeks, earnings have actually been revised lower. They started out higher than our target, which is 275 on the S&P 500. They're now a bit lower than our target, but we're still comfortable with that 275 number. And what that means is about 12% upside in terms of earnings. And we think that's going to drive prices higher by low double digits.
Tracy, the earnings are one thing. How the market responds to the earnings is another. Let's take NVIDIA as an example. Most of the analysts on the south side said those numbers were decent, they were okay. The CEO seems to think everything's amazing. Then the stock got sold really hard into the close, down by more than 8%, and there's no bounce this morning. The stock's lower again in the pre-market. What's the signal, as we often ask on this program, Tracy, that you can take away from how the market is responding to the information?
Yeah, that's an interesting case. We saw somewhat similar reaction last quarter, even though the company reported very good earnings and decent forward guidance. What is happening there is the growth of earnings is starting to slow. But we think that the narrative continues to be positive for the AI theme. It's just moving away from semis somewhat. So we're broadening out our exposure to things like energy and industrials that should also benefit from the AI build-out.
At the same time, Tracy, those elements of the market got bid up at the end of last year as well. The AI trade had many tentacles, boosting utilities as well. How do you know when the momentum unwind takes on a life of its own? I mean, at a certain point, you can be excited about the earnings of the broader index, but if you have the leadership over the past year just absolutely getting hit very hard, that's going to lead to outflows. At what point do you take note?
Sure. So I think some perspective is probably warranted here. Just last week, we were hitting all-time highs on the indices. We're down about 4% on the S&P 500 so far this week. It's happened relatively quickly, but drawdowns usually do. At this point, it's related to what we think is a soft patch. We don't see it developing into anything more at this point, but obviously, we're going to be watching the hard data pretty closely. It's mostly coming in soft data right now. But some taking of gains is to be expected after such a strong fourth quarter. Consumers starting to pull back on their spending after spending so heavily in the fourth quarter, all to be expected and could also be attributable to seasonals.
You sound incredibly calm, which is refreshing, and it's something that we've been hearing from a lot of people. Ignore the noise, look at the trend. This is an economy that's strong, and some of the policy noise will eventually fade later this year. We were speaking with Greg Dako earlier, who talked about preemptive inflation anxiety and this idea that consumers were starting to adjust their inflation expectations and potentially their expectations for job growth ahead. At what point does that feed into your outlook, that even if some of these policies are noisy, the noise is having an effect in its own right?
It is having an effect, Lisa, you're right. And sequencing matters as well. There are 4 major policy initiatives of the Trump administration. 2 of them are relatively negative, 2 are relatively positive. The negatives are tariffs and immigration policy, and then tax cuts and deregulation are the positives that are likely to follow. So what we're seeing now is some of the more negative policy being implemented and consumers reacting to that. In terms of inflation, we do think that tariffs are going to add to inflation, and we've got a 3.3% inflation rate by the end of the year. We also have higher yields and growth of about 2.5%. So we think all of that can support equity markets through the end of the year.
Hey, Tracy, appreciate your input. Still constructive. Tracy McMillan there of Wells Fargo, echoing what we heard from BlackRock earlier on this morning, echoing what we heard from Federated Hermes and Steve Orth earlier this week.
So there's a question between ignore the noise and be excited about something coming down the pike and just block your ears because it's just too confusing to really pay attention and miss something that is really potentially pernicious. This is such a difficult moment. It's almost like people are lined up. Either this is a market that's complacent and looking past tariff risks at their own peril, or this is a market that is so wise as to understand that this is so noisy that they don't have to pay attention.
A noise or a freight train, you've said it a few times already this morning. This potentially is just noise or a freight train. 25% tariffs on Canada and Mexico set to go into place on Tuesday. We'll see. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Elsewhere in trade talks, President Donald Trump and UK Prime Minister Keir Starmer discussed a potential trade agreement during a joint press conference at the White House. Trump said that a deal could take shape very quickly, and administration officials have already begun working on it. A deal would mark a win for Starmer, exempting the UK from U.S. tariffs. The U.S. Securities and Exchange Commission has expressed concerns about State Street and Apollo Global's private credit ETF. Regulators are concerned over the fund's liquidity, its name, and its ability to comply with valuation rules. The ETF officially launched on Thursday. Citi accidentally credited $81 trillion to a customer's account instead of $280 last April. The Financial Times reporting that the bank reversed the transaction hours after. It contains echoes of when Citi accidentally sent $900 million to a group of creditors 5 years ago, since which Citi has continued to fix its operational issues. And that's your Bloomberg Brief. John.
Hey, Danny, thank you. More from Danny in about 30 minutes' time. Up next on the programme, the Morning Calls, plus Tom Narayan of RBC as automakers gear up for tariffs. That conversation up next. We'll catch up with Anne-Marie on the other side.
On the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and the ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
The opening bell about 1 hour and 17 minutes away. Going into that, NVIDIA at the moment, negative again by 2 percentage points in a pre-market. Keep one eye on that. Equity futures just about positive on the S&P, but unchanged now on the Nasdaq 100, down by about 0.1% on a Russell. The next stop for the market, it's about the economic data. 17 minutes away, core PCE, the Fed's preferred read on inflation. Remember, CPI came in hotter than expected, so did PPI. But the components of PPI that go into PCE were softer than expected, so people are comfortable with the data we might get, Lisa, at 8:30 Eastern Time.
Got that? Good. Me too. Honestly, this is basically going to be an exercise in math where people take a look at this and try to backload the narrative of either stagflation and slowing growth and potentially having inflation picking back up, or everything is fine and disinflation is back in order and you can have a weekend again. So this is essentially how people are going to spin it, more interested in the market response than the actual number.
That sounded personal. Mike McKee's going to be with us in just a moment to break down the economic data. Let's get some morning calls. First up, BTIG initiating coverage on Novavax with a buy rating, citing the company's standalone COVID vaccine. Your second call from Deutsche Bank downgrading Walgreens to sell, noting a deal with Sycamore Partners that could be tough to implement. That stock is down by 3.5% in early trading. And finally, Morgan Stanley lowering its price target on HP to 35, saying its guidance, quote, feels ambitious amid market uncertainties. Lisa, that stock's down by 3.5%.
This was actually one of the more interesting stories that we got over the earnings cycle. They came out and they said that rising component costs and U.S. tariffs on imports from China are weighing on profit. This is a tangible response to what we've seen in terms of the proposals that have been real, that haven't just been noise. Expect to hear more of that, but that to me really stood out.
And a whole lot more if this happens. Let's turn to the autos. Car makers bracing for 25% tariffs on Canada and Mexico, set to begin on Tuesday. Anne-Marie is back with us in D.C. Anne-Marie, a lot of people in this market do not believe this is going to happen.
No, they don't. And they're seeing some of the signals that we're seeing in Washington, D.C. every single day. You had Canada's fentanyl czar here talking to the U.S. border czar, Tom Homeland. You also had Mexico's economy minister sitting down with USTR ambassador Jamieson Greer yesterday. And then today we'll be meeting with Howard Lutnick, the commerce secretary, and also a number of initiatives that we've seen proposed by Canada and Mexico. The question is, will this be enough? When I speak to officials, and I've been speaking to them for the past 24 hours, they said the president is keenly focused on the amount of fentanyl that is coming into this country and American deaths caused by fentanyl. They want to see that come down. The issue is that is going to be for market participants and specifically executives in the auto industry like Jim Farley, who's also been making his way in and out of Washington, D.C., is the auto space. What would this mean, 25% on Canada, Mexico, to a highly integrated supply chain amongst the auto sector between these two countries? Jim Farley said, let's be real honest, long-term, a 25% tariff across the Mexico and Canada borders would blow a hole in the U.S. industry that we've never seen.
Anne-Marie in Washington, D.C., Jim Farley earlier this month. What we're seeing is a lot of cost, a lot of chaos, a lot of pushback from Ford.
And GM as well coming out and saying essentially you will kill this industry. You are going to make it impossible. If you want to celebrate American manufacturing, this is not the way to do it. Donald Trump has hit back saying that this is going to redevelop places like Michigan in bringing production back to the United States.
Here's the take from RBC and Tom Narayan. Investors continue to expect there won't be permanent tariffs. Automakers can handle them if temporary, but if permanent, would be problematic for the U.S. auto industry. Tom's back with us around a table. Tom, it's good to see you as always, sir. Good time for a $6 billion buyback?
For GM? I mean, it would appear so. The market liked it. And, I mean, it was telegraphed that they would do that buyback. And I think it is indicative of what we're seeing from investors, right? There's no expectation that these will be permanent tariffs. The automakers said they can handle short-term tariffs, right, that last a few weeks, et cetera. That's, I think, what people are baking in, that we may have them, but they eventually will end in some sort of a deal between governments.
It's such a strange moment because so many people don't believe it happens, and then they believe if it does happen, it won't last very long. Where does that all come from? Why don't we believe what the president is selling going into next week?
Well, we saw what happened when the initial announcement happened, right? The market pretty much tanked, right? And then immediately you had, actually, it's delayed. So I think there's an expectation that the administration doesn't want to tank the economy, doesn't want to tank the market, and that maybe cooler heads might prevail, just like what we saw, by the way, in the first Trump administration, right? So I think that's what investors are thinking, and they're also rationalizing by saying, who exactly are you helping with the tariffs? Which U.S. industries actually helped? And that's what they're thinking, that ultimately the administration will be more pragmatic and look for a deal between governments as opposed to trying to penalize the U.S. auto industry.
Can you quantify how much these tariffs are actually priced in any capacity to the auto manufacturers' shares?
A very small amount, but some of it is factored. The reason is, if they're permanent tariffs, I used the example before of this negative infinity case.
Love that.
Right. They would be so disastrous, double-digit hits to earnings. We're definitely not having that in our earnings estimates that we're seeing from the sell side, the consensus, but we are seeing some downside that's happened, maybe a few percentage points. So if there are no tariffs, there's actually a reason to be constructive on the space. Obviously, if there are permanent tariffs, it's the opposite.
Well, this to me is such a fascinating point. It's sort of John's idea. If you really think that Armageddon is happening, you might as well buy tons of stocks and go completely risk because you've got nothing to lose. I guess at a certain point for these car manufacturers, why don't they all go GM? Why don't they all just buy back their shares and say, look, why keep some dry powder when you can't really prepare for Armageddon? So, you know, here you go.
Well, I think GM is in a different position than some of these other automakers. We saw Stellantis earlier in the week, et cetera. GM is
looking good.
Yeah, very healthy balance sheet from GM. They're selling stuff that people want with very high profit margins. They didn't go crazy with high pricing. They were disciplined. And they can manage a near-term tariff issue by keeping stuff in the U.S. So I think that may be a different story. But to your point, yeah, why not overlook this? I think investors are overlooking this. I think investors, for the most part, are staying in the sector, and they're hoping that cooler heads will prevail.
They say they're going to be agile and respond to policy changes. What does that actually mean in practice? Because we may well get the tariffs go on steel and aluminum, even if we avoid Canada and Mexico. And they're the kind of downstream manufacturers that will be hit by higher prices on steel and aluminum. It will take time to get that supply side response domestically. What does it mean for those manufacturers for being agile?
For steel and aluminum, it's actually not as bad as people think. You know, people forget in 2022, we had this huge spike in steel and aluminum, unrelated obviously to tariffs. The auto industry kind of held firm. They were okay with it because they're able to, the way the supply contracts are structured, it's basically a 1 to 2 year delay and a lag effect, and then their hedges. So actually, it's not as big of an impact as these tariffs would be.
I'm going to make the turn to Tesla because Tesla just feels like a completely different conversation. Why is Tesla getting hit so hard now?
I think you have to put stuff in context with Tesla, right? Like, remember, with the election, the stock went doubled, right? $1.4 trillion market cap.
Yeah.
It's now pulled back to close to $1 trillion, I think. It's definitely pulled back quite a bit, but it's nowhere near back to where it was pre-election. So I think some of that run was kind of animal spirits. Recently, I do think some people are looking too much into this Europe data that came out, right?
Okay, let's go there. Why is that the wrong way to look at things? Because sales in Europe were dreadful. Why is that the wrong way to think about the stock?
Here's the math comment for the day. So I always, the example, there's 3 of us here, right? If one of us left the room, that's a 33% cut to people in the room. Oh my God, what a big number, right? So people are looking at the Tesla numbers down 45%, but that's like 17,000 going to 10,000, right? Tesla in Europe. Tesla for January, everyone's freaking out about the January number. They sold 1.8 million cars in 2024. Oh, by the way, they also had intentional shutdowns because of this Model Y refresh.
Okay, all right. Yeah. But if one of us leaves, that person is important. And I think that if you did more broadly...
more important. You are more important, just to put it out there, all right?
All right, stop it. All right, move on. It's okay, move on. So here's the issue that I have. There is this feeling that maybe some of Elon Musk's personality is becoming an increasing liability, and that maybe his mind is distracted somewhat with all of his additional duties. Why do you completely reject that and say keep your eye on full self-driving and what's going to come down the pike?
Yeah, because that company is not one man. It really isn't. I promise you. There are a lot of really amazing, brilliant people, friends of mine that work in this company. He's also brilliant, by the way, the CEO.
Of course.
And so it's more than just one person. And the things that the company is doing, there's proof. I mean, the robotaxi market, the industry here, in my valuation, is huge. I think it'll transform society significantly. And they have the best level 2+ offering right now, FSD, which will be leveraged to do this robotaxi effort. I'm a believer. And so, you know, I look at that, I look at the math around that. I'm not too worried about the car numbers. It's a small part of my valuation. They have this new model coming out in H125, whatever that means.
Yeah, well, we had an analyst on yesterday, Ron Yevsikov of Guggenheim, and he has a sell rating on Tesla. And he was saying that he thinks that when they come out with this model, it's going to be a sell-off, it's going to be a risk-off moment, simply because people are going to realize that it's much further off than we're currently baking in, the idea that we're all going to just have cars that drive us around and tell us how great we are. But I'm just curious, what is your evidence where you think that we can bring this forward?
Yeah, I think there's two different things. One is this newer affordable car. I would agree. There's a lot of pessimism there, right? Especially because the IRA credit is gone, so this could be priced at like $37,000. Yeah, I definitely appreciate the concern there. But consensus numbers for sales, for car sales this year, is like up mid-teens. I think that's doable when you have a newer model that's priced lower. So I'm not as concerned there. Why I think you can be constructive, first of all, there's been a big pullback. And this stock isn't necessarily tied to fundamentals, shocking. And so potentially you look at the kind of yo-yo effect of what could happen here with the stock. You do have this June unveil of that service in Austin. Yesterday they announced this California permit request. Now, obviously there's some overhang there. What if there's some delays with the service in Austin? What happens in California? I'm not denying that there's hair on this, right? But I think people need to look past this delivery number. I think people need to appreciate the fact that autonomy is happening. And to give them credit, you know, they did do this permit in California, Austin, June, the timetable is real. And like, I think a lot of people, they look at robotaxis and they're like, well, I look at FSD and I have to intervene all the time. How sure are we that his software can handle a robotaxi? I don't know if you guys have been in a robotaxi. It's very boring. It's a slow-moving urban environment. It's usually in very warm, good climate cities. It's actually not as difficult as going on the highways and arterial roads. I actually think it can be managed, and sooner than maybe a lot of folks fear.
Tom, always appreciate your time. It's good to see you. Thank you, sir. Tom Naran there of RBC on the prospect of auto tariffs. And then Tesla on a 6-day losing streak, down about 22% over that period. But over the last year, that stock has been absolutely flying. Coming up on the program, breaking PCE data and personal income and spending. We'll catch up with Andrew Honhorst of Citi and Michael Kushmer of Morgan Stanley.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
There is this real momentum from Wall Street.
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Another read on inflation coming right up. The scores going into that look like this. Equity futures on the S&P 500 positive by a little more than 0.1%. Down 1/10 on the NASDAQ. Down 0.3 on the Russell 2000. CPI came in hotter than expected. PPI came in hotter than expected. The components that go into PCE a little bit softer than expected. So no drama anticipated in about 3 seconds' time. Mike McKee's going to break down that data. Mike McKee, good morning.
Good morning, John. We're waiting for the PCE numbers to drop. Let me quickly give you the advanced trade balance. This is terrible news. Negative 153 billion. Last month shocked at negative 122. Let's just put it this way. If Tariff Man is unhappy about the trade balance, he's going to be very unhappy about this number. All right, here's the inflation data. The PCE index on a month-over-month basis comes in bang on expectations, up 0.3%. Same for the core, which pushes us bang on to 2.5% for year over year on the headline and 2.6% for the core on a year over year basis. And as you pointed out, this is better news, softer inflation than we saw in the CPI and PPI, very much expected by the markets and the Fed. So probably not going to have a lot of impact on them other than to show we're still making progress. Now, here's the good news. Personal income up 0.9 during the month. We were expecting a 0.4 rise. Now, we'll have to look into the details on that because what happens at the first of the year, of course, is we tend to get the increases in things like Social Security, et cetera, adding to people's checks. Personal spending, though, falls 0.2. It was up 0.7 the prior month in December, so a much worse than expected performance there. Real personal spending after adjusting for inflation is down by 0.5%. So some bad news on the consumer front that's only going to reinforce what people have been talking about in terms of maybe there's a slowdown out there. I'll try to break down all the numbers while you get the reaction to this.
We'll come back to you in a few minutes' time. Mike McKee, thanks for breaking that down. Appreciate it. Equity futures on the S&P still positive, up by 0.4% off the back of these numbers. In the bond market, yields almost unchanged now. The 10-year bond yield higher by a single basis point of 4.27 in foreign exchange. Just to look at the dollar against something, let's look at it against the euro. Euro dollar around 104, 104.11. Andrew Honhorst of Citi is with us around a table to break down the economic data. Andrew, good morning to you. We'll get to inflation in just a moment. Let's start with personal income versus personal spending. Income up, spending down. What gives?
Yeah, this is really interesting because we've had such strong personal spending that has been the engine of growth and resilience for the U.S. economy. And now in the month of January, we're seeing that weaken. We already knew some of that from the retail sales reading. We're seeing a little bit more of that in what we're seeing in personal spending this morning. I think you have to take that with all the positive data we've had for the last several months, but this could be the start of a slowing trend.
Soft data has been soft. You, Mitch, on the consumer, soft. The conference board earlier this week, weak. I want to understand whether that is going to translate into weaker hard data. It's early to say that, yes, we're seeing that right now with conviction and confidence, but is that what you're forecasting?
We think we're going to see at least some slowing in consumer spending. I think you kind of have to, just because we've had the savings rate at such a low level, and you can't just continue to run spending above income forever. So it was always going to slow down. I think the question now is it slowing a little bit more sharply? And it is interesting what you mentioned, because you see this across the soft data, the consumer surveys, and then also that services PMI. That was really the big surprise, that number came below 50, coming into contraction. And now we're seeing it in some of the hard data. Now, again, we had really strong consumer spending in December, so I don't think you want to make too much of this weakness in January. Maybe February, we're going to go back and just continue expanding again. But if we get a weak reading in February, then that is a trend, and that does line up with what you're seeing in the survey data. So, a little more of a hint here that we're slowing down.
Yeah, it goes to this whole preemptive inflation anxiety. Is this the evidence of it right here, that people are stockpiling more cash, they're earning more, and they're spending that much less? You're saying it's too early to call that this time, but going forward, we'll have to see. You've been generally calling for a weakening in the economy even before some of this PIA. I'm curious, what are you looking at right now that gives fuel to that, even amid the otherwise pretty benign outlooks that we're hearing from companies?
I mean, if you think about the things that have supported this economy, and again, it's been a consumer spending story, and it was the fiscal stimulus, it was equity prices that were up 20% year after year, it was house prices that were up much faster than is typical, and none of those things are happening now, right? The fiscal is coming off, you have equity markets that are kind of moving more sideways, house prices are still increasing, but not increasing at those really rapid rates that they were before. So all of those tailwinds to growth are diminishing. So I'm not surprised that we're seeing some slowing. Now, to your point, are we seeing maybe somewhat of a sharper pullback because there's some uncertainty out there? We could be seeing that. I just think it's premature to really say that we know that.
You were calling for many more cuts than other people and talking about the generally weakening economy paired with real disinflation. And this has been something that's come under challenge recently from a policy overlay, that maybe some of the tariffs and the rejiggering of the global trade sphere would end up with a higher level of inflation more permanently and stagflation like situations. How much do you lean into that? How much do you think that that is kind of what we may see?
Yeah, there's no question that there are concerns, and there should be concerns about longer-term structural inflation. If we're going to a more fragmented trading environment, that's just going to be more inflationary for the global economy. But what I'm really looking at right now is the cyclical story. What's the cyclical story that we're seeing in the U.S.? And what we're seeing in those cyclical categories of inflation, things like shelter inflation we were just talking about, that's cooled, and that's probably cooled persistently. So I think that's part of what we're seeing in the market also, is not that necessarily we've reached where we're trying to get to, or the Fed's trying to get to on inflation. It's not that we're at 2% inflation. Clearly we're not. We're a bit above that. But that pathway is there. And if there's less concern about inflation staying elevated, then concerns can shift to some of these growth concerns, and it becomes a little bit less balanced. And so I think we're still very early innings of that, but maybe that's what the market's doing a little bit.
Andrew, a lot of people are blaming the trade headlines. Neil Dutta of Renmac made the case on this program earlier this week that was an ex-post rationalization for a slowdown that's already started. Would you agree with that?
Yeah, I think so. I think maybe in some of the consumer sentiment data, you're seeing some of those trade-related anxieties reflected, so that can affect the soft data. But spending for the month of January, I really doubt that this is being affected by trade uncertainty.
You say it's a cyclical kind of weakening. At the same time, some people think that maybe the momentum is just moving away from services back to goods, and that you might see some of the weakness in services paired with some of the strength that we're seeing in the physical world. Why do you reject that?
I don't necessarily reject that. You do see that to some extent in some of the survey data and some of the diffusion indices, where you see this sub 50 services diffusion index. So maybe we're actually contracting in the services sector, whereas manufacturing diffusion indices have moved above 50 now. So you do see some of that in the data. But what I would say about manufacturing is, number one, it's a smaller share of the U.S. economy than services. Services is going to be the more important driver. And number two, we still have high interest rates. We still have a strong dollar. Those are things that are going to weigh on manufacturing as well.
First rate cut, give us the month.
May.
Why May?
We think in May they'll see enough, Fed officials will have seen enough to conclude that inflation is slowing, that growth is slowing, and resolve some of the uncertainty around tariffs and trade. April 2nd is the date when we're supposed to get some announcements.
Is March 19th a snooze or not?
It is just probably a wait-and-see meeting, yeah. I don't know if I want to say snooze, because it's my job to make these things interesting, but I'll be tuning in. I'm not sure a lot of others will.
We'll be here. Andrew Honhorst of Citi, I hope others tune in as well. We'll have a special program, March 19th, the Fed decides.
I'll just sleep through it. We'll see you.
Mike McKee's going to be there too. He's back with us now for more. Mike, you've had a few more minutes to go over the data. What jumps out for you?
And I've got to, like Andrew, make people think it's an important meeting. We will get new economic projections, and this is going to all feed into it. The interesting thing about wages and salaries up just 0.4, same as last month. So the money that really came into this 0.9 had to do with two things. Farm income, transfer payments for the government to farmers up 39%. In January of a year ago, it was only up 10%, so a big change there. Social Security payments up 2.8%. Everybody gets a raise on that. And then the money that comes in from the markets, interest income up 0.4. Dividend income, though, up a strong 1.7%. We had a revision to spending in December, up 0.8 instead of 0.7, so marginally less worse than it appears. But overall, it's still not a great performance on any of these things.
Mike McKee with the latest. Michael, thank you. The latest economic data came out about 9 minutes ago. If you are just joining us, core PCE coming in line with expectations. Economists are getting very good at forecasting this number. Once they see what goes into the likes of PPI, even though CPI came in a bit hotter, this comes in line. If you're looking at personal income and personal spending, though, that's where the debate is right now in the economy. Income was higher and higher than expected. Personal spending was lower and lower than expected. And I think that gets a lot of people talking about maybe some nervousness out there for the consumer.
If you're uncertain, excuse me, about your future, if you're worried about your job, if you're worried about prices going up and you haven't been saving, what will you do? You will save some dollars. And that is what these numbers seem to suggest. 1 month can be messy. We will have everyone tell us that we should not count it. We should just put it in our little dot plot, our own personal dot plots, which I will be doing tonight.
Okay, and then updating them again on March 19th when the Fed speaks. Michael Kushner of Morgan Stanley joins us now for more. Michael, jumping into the seat, into the studio. Good morning, sir.
Good morning.
I mentioned BNP Paribas, who said a few times earlier this month that the Federal Reserve was comfortably numb. How uncomfortable are they going to be in a few weeks' time?
It's going to, well, they may be uncomfortable, but they'll have more information about exactly how serious the Trump administration is on imposing these tariffs, because we know that the use of tariffs has multiple objectives. One is to extract other concessions on other issues. Second one is to raise revenue to achieve their budgetary goals. So how those are balanced and the inflationary impact versus the negative economic growth impact, juggling all those things, we're not sure how they're going to weigh those things, and the Fed has to wait to see how they're going to judge those factors.
Got to make some kind of underlying assumptions, though, about how this is going to play out for the year ahead. What's your base case? What's the baseline for you and the team?
The base case is that, in general, macroeconomics was just tariffs are stagflationary. It's like a tax on the economy with like a supply shock, and it's not good, at least in the short term, before longer term production adjustments can occur. So in some sense, you would think this puts the Fed in an uncomfortable position because stagflation outcomes are ambiguous as to what you should do. How big a negative impact will have on the economy in the short term versus how inflationary it will be. And you think about, the Trump administration's policies could be, there's positive things about it, there's negative things about it in terms of supply side, demand side, but the headlines in the short term are quite, with the trend in spending and the economy a little weaker than expected recently, is putting this a little more downward pressure, which makes, I think, maybe a little more nervous that maybe of the next couple of months that the economy may be softer than expected.
It's difficult to have conviction at a time where, as Goldman Sachs put it, you end up with headline roulette. How can you basically come up with any kind of conviction if you're dealing with potential threats that emerge that are unclear at different moments? Do you have any conviction yet?
Well, conviction has been that the underlying momentum of the U.S. economy has been strong, but narrowly based. The Biden administration was a lot of government spending, tax policy driven growth in the economy. Employment growth was strong, but inflation was high. We kind of knew what to do with that. The Fed would cut rates if inflation was low and there was some signs of weakening the economy. But going forward, I think it's much more uncertain as to how the economy is going to play out. So you have to wait and see. So we've adopted a more wait and see attitude. We think credit markets are still pretty robust. Corporate fundamentals are really strong. Could they deteriorate at the margin? It's possible. So we're a little leery of adding and taking big bets in credit markets. But on the other hand, there's no signs yet that the weakness we've seen lately. Remember, January and February were really weird months in terms of forest fires in California, really cold weather, how that was disruptive to it, tariffs and Trump policy, how disruptive that was to people's behavior. Headlines are certainly not very conducive to being confident about the future with layoffs, falling spending, reductions in government spending.
So what would it take for you to get bullish on long-term bonds to actually think that this is going to be a growth impact?
We'll have to see the unemployment rate change. I think the Fed has an employment mandate and it has an inflation mandate. And the inflation situation was not great lately, but this could be better in the next couple months, or it could just go sideways. But the unemployment rate stays where it is. The Fed's going to find it tough to change policy from where we are today. But we have seen big swings in Fed attitudes towards policy in the last 12 months. July and summer of last year, when inflation was going up after the first half of the year, the Fed said maybe no rate cuts remainder of the year. By September, lots of rate cuts. And now maybe not so many rate cuts. I think they're very much in the thing, we don't trust our models. We're going to wait and see how actual data evolves, data dependent, but they seem to be very responsive to short-term fluctuations in data, which have been fairly erratic.
We've seen risk markets, risk assets get hit a little bit over the last week or so. Is the Fed put constrained, given the risk that they face, the two-way risk that some people have described?
I think it's constrained from the point of view of responding immediately to weakness in equities. If spending in the U.S. economy, we know, has been led by the high-income part of the distribution. And as we know, wealth effects have been very powerfully positive for high-income people in terms of the equity market, the housing market, crypto markets, whatever you want to call it. It's all been up, up, up. So even if income growth hasn't been great, you feel wealthier, you spend more money on durable goods and holidays and things like that. If that is starting to start to worry about that, and there's a story that the Fed is indirectly targeting the equity market. The economy can't slow, inflation can't slow unless the equity market does worse, because that will slow spending of high-income people.
Does that help or hurt the 10-year?
It helps the 10-year. I mean, there's a story that I've seen around that maybe the Trump administration is not targeting the S&P as a measure of success. It's the 10-year Treasury. Yep. The lower it goes, the better.
So let's just do some scenario analysis. Next year, by the way, I'm turning into TK with my throat clearing, and I apologize.
Sure, Tom appreciates that.
Well, he said this chair is one thing that leads to another. I am curious. Next week, on March 4th, if the tariffs are put on, what happens to the 10-year? Does it rally or does it sell off?
I think it rallies.
Significantly.
I think the markets are more concerned with downside implications for growth than they were about upside inflation surprises.
What shifted from late last year till now?
I think it's the actual data that's been weakening prior to all this tariff stuff, when people were not sure that the administration was serious about imposing tariffs. Well, this is just a negotiating tactic that could go away. But data has actually been weakening into this environment. So the economy is more fragile, not for weak growth, but weaker growth. So you think U.S. growth has been toggling between 2% and 3%. Well, if we fall below 2%, I think the Fed starts becoming more operative again.
Michael Kushner of Morgan Stanley. Lots to think about, sir. Thank you. If you are just joining us, welcome to the program. About 16 minutes ago, I had some economic data here stateside. No big surprises on PCE. Let's focus on two surprises. Downside surprise on personal spending. Talked a lot about that. The goods trade balance, much more negative than anticipated. Maybe just a little bit of front loading there, Lisa, going into the tariffs.
That was exactly my thought process. How many companies are starting to stockpile ahead of whatever might happen? They might hear it as noise, but, you need to put some insurance on.
The opening bound just around the corner. Equity futures still positive by only 0.25%. With an update on stories elsewhere, here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Just to recap some of that data, the Fed's preferred measure of inflation slowing in line with expectations. Core PCE rose 0.3%. That is the lowest since March of 2021. At the same time, though, as you mentioned, consumer spending fell 0.5%. That is the first decline in a year. That drop occurred even despite the data showing a surge in income. Apollo Global Management is in talks to lead a roughly $35 billion financing package for Meta, helping develop data centers in the U.S. People familiar said the conversations are in an early stage and there's no guarantee that a deal will be completed. KKR, also part of that investor group. Meta has already outlined plans to invest up to $65 billion on AI projects this year. BlackRock has ended its diversity goals. In a Friday memo, executives said it will abandon specific targets to increase representation and no longer require managers to interview a diverse slate of candidates. Teams specifically devoted to DEI will also be subsumed into one talent and culture group. The memo cited changes to the, quote, U.S. legal and policy environment related to DEI. And that's your brief. John.
Danny, thank you. Thanks for this morning. Enjoy your weekend. Up next on the programme, we'll set you up for the day ahead, get you some movers before the opening bell with Yahira, and catch up with Anne-Marie down in Washington. We're looking ahead to a day full of action. From New York City, this is Bloomberg.
Behind the bright lights and adrenaline of pro sport is an equally exciting world of negotiations and deal making.
That's what we cover each week on our podcast, The Deal.
I love the fact that you have, we say the cojones. I can't say that in Bloomberg.
Maybe moxie.
Yeah, moxie. I'm Alex Rodriguez, former baseball player turned business executive.
And I'm Jason Kelly, a journalist at Bloomberg. Over the next couple months, we'll hear from all-stars like Billie Jean King.
Well, what should I learn? What should I do? I said, learn the business.
Jay Williams.
You're an asset, but how do you become the principal?
Paul Rabel.
We're going to be the league of digital, and that's why you're going to invest.
Adina Friedman.
I definitely am competitive.
David Rubenstein.
People don't come up to me on the street and say, let's talk about this private equity deal you did recently. Nobody does that. They say, let's talk about the team.
And so many more.
You need a clap?
No, I never. Ready? Go.
Good morning. This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
U.S. tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
The opening about 38 minutes away. Equity futures right now positive by 0.2% on the S&P. We're down on the week. We're down hard on a month. On the Nasdaq 100, down by more than 4% so far in February. On a Russell, down by more than 6%. The small caps negative by a little more than 0.1% this morning. With some movers going into the cash open, here's Yahira Hacker. So Yahira.
Hi, John. We start with NVIDIA here, lower 1.6% after falling like a rock yesterday, down nearly 8.5% yesterday, with all this telling us that the earnings were just not enough to assuage investor concerns, especially the one that DeepSeek highlighted, which is that you can optimize your AI models to require lower compute power, meaning you might not need NVIDIA's high-powered chips. Those concerns obviously still lingering here Next up, we have shares of Alibaba. Those are also lower, down 3.5%. And it's one of those Chinese stocks listed here in the U.S. that's getting hit due to Trump threatening more tariffs on China. And the reason that could hurt Alibaba is because of its e-commerce platform it operates here in the U.S., AliExpress. If items on there coming from China get more expensive, maybe Americans will turn to the likes of Amazon or Walmart, which could hurt Alibaba. And last up, we have shares of Bloom Energy. Those are rising 3.8%. The electrical power equipment company revenue in the fourth quarter blew past analyst estimates. It's one of those companies that's, of course, benefiting from the growing demand for power due to AI. John?
Yahara, thank you. Thanks for this morning. 3 of the movers to watch going into the opening bell. What a week coming up over the next week. Check this out. Tuesday, Trump's tariffs going into effect potentially on Mexico and Canada, and an additional 10% on China. Plus, President Donald Trump delivers his joint address to Congress Wednesday. ADP payrolls, PMIs, plus the Fed's beige book. Thursday, another round of claims. Friday, this time next week, the big one. The payrolls report is just around the corner. Before we get there in just a few hours' time, President Donald Trump meeting Ukraine's President Volodymyr Zelensky at the White House. AMH joins us from Washington for more. Anne-Marie, what's coming up?
Well, at 11 a.m., Volodymyr Zelensky, president of Ukraine, will be arriving at the White House, and then they're going to spend a few hours together, including a bilateral lunch, and then this will culminate into a press conference. And I really think that press conference is going to be incredibly important. Professor Edward Fishman joined you guys earlier. Soften the tone when it comes to President Zelensky. He said he's looking forward to this meeting. He talked about the fact that the two will sign this mineral agreement that Scott Bessent told us last week, the Treasury Secretary, that bringing closer economic ties between Kyiv and Washington in itself is a security agreement. So how President Trump talks about these negotiations, potentially the next step, being more talks with Putin and a ceasefire, will be incredibly important. And for Zelensky, this is critical. This has to be the most important meeting of his political career right now.
Anne-Marie, down in Washington, thanks for the work this week. Appreciate it. We'll see you after the weekend. AMH, with the latest down in Washington. What a week coming up. We've got this amazing situation. 25% tariffs potentially going on. Two of the biggest trade partners of the United States of America, Canada, Mexico. Nobody on Wall Street that we've spoken to believes it's going to happen. And of the few that do, they don't think it lasts very long. That's the situation we're in right now.
As Tom Narayan said, why would this administration want to torpedo entire swaths of the U.S. Auto industry, which seems to be what would happen, at least in the short term, should these go on? We have to keep going back to it. Are you ignoring noise or are you ignoring the freight train? And I keep saying that because you have to think some of these things are real. And at what point can you remain sane while also being aware of risks?
Some of these things are real. 10% tariffs on China. Everything is relative to expectations. Expectations for tariffs are so high that we're just ignoring 10% tariffs on China here, 10% tariffs on China there. It's happening.
Well, headline roulette. We got another round of it coming up, and we've got a weekend of it, and, you know, we'll be here for it.
Another week of it. Coming up on Monday, Laurie Calvasina of RBC, Mohammed Al-Erin of Queen's College, Cambridge, Liz Young of SoFi, and Robert Tipp of PGIM Fixed Income from New York. Have a wonderful weekend.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
You are also an owner, I should have pointed out, of 3 major sports teams.
That's right.
And you're the first woman, as I understand it, the first woman to own 3 major, have a stake in 3 major sports teams. Is that right?
Yes, and we'll say African American.
You were approached by the owner then of the, I guess, the Washington Wizards and the Washington Caps about maybe buying the Washington Mystics, which is the women's basketball team. And what did you say?
Well, first of all, Zay Poland he did come to me and Susan O'Malley, and they said, Abe Polson says, look, I want you to be the face of the Washington Mystics. And I said, what do you mean be the face of? He says, I want you to buy this team. His health was failing. And I have to tell you, and a lot of women can understand this, we never get these opportunities. So that was the first thing that struck me, and I was flattered. I was really flattered. I said, well, Abe, what are the financials on this? And he handed them to me. He says, well, they're not making money. But I was still intrigued about team ownership.
In case you missed it, from Bloomberg's coverage at Davos.
Do you think there's one particular thing that you'd like Trump to change in terms of what some people see as the over-regulation of banking in America?
I don't believe, honestly, that we should have a huge amount of deregulation for larger banks. I think that's, you look back at COVID and any crisis, big banks now are strong, are able to step in and being part of resolving issues rather than being the one that creates issues. So I wouldn't really welcome a huge wave of deregulations. What I can see is that, of course, what happened in the US doesn't mean automatically that you will see in Europe or in Switzerland or in Asia deregulation. So the fact is that US banks may become even more competitive internationally through a more benign environment.
Nobody covers Davos like Bloomberg.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
All right, tariffs hitting hard, but stocks not really reacting. 30 minutes until the start of the cash trade. I'm Matt Miller.
And I'm Sonali Bassett. Katie Greifeld is off today, and Bloomberg Open Interest starts right now.
Coming up, Beijing's warning. China vows to hit back with all necessary measures as President Trump fires new tariff threats. And all that tariff talk is rippling through the markets with CEOs from Amazon to Hewlett-Packard sounding the alarm. Plus, a multi-trillion-dollar mistake. Citi reportedly credited $81 trillion to a customer account instead of $280. Details ahead on that blunder at a bank that has a history in that sense. First off, though, let's take a look at where the markets are trading. In terms of stocks, you actually see gains on futures this morning. S&P futures up 0.2%. Of course, we had a big 1.5% drop yesterday. And you do see really an elevated VIX, but the 10-year yield continues to move lower. Right now, 423.68, and we kicked off this administration around 475. So they really have moved down that yield. The question is, for what reason? Is it a growth scare, or are we confident that inflation is under control?
Stunning. 423. We are more than half a percentage point lower than we were just in January. Let's see how low we can go. Some things moving lower as well. Those big tech stocks, particularly HP here. Of course, we're looking at the numbers down more than 4% pre-market. Profit outlook fell short of expectations. They cited tariffs and rising costs of components for its products. So even a lot of the macro threat really hitting into the big tech names. Dell Technologies down 6.9%, almost 7% pre-market. They plan to ship $15 billion worth of AI servers this year, a 50% jump from last year, but it's not enough to impress Wall Street. And NVIDIA is ending the week where it began, which is lower, 1.8% lower today, and it's sliding as subdued growth in the last quarter and mixed guidance for the year weighs in on sentiment, which has also been pretty muted here, Matt.
Yeah, you know what's interesting, Sonali, if you take a look at how poorly U.S. stocks have performed, it brings into question the idea of U.S. exceptionalism. Year to date, if you look at U.S. stocks versus the rest of the world, it's the worst start to a year since 1994. You know, some of us were barely even born at that point. And then I have here the yellow line. It's an inverted 10-year, just to show you the rate of change that we've seen in terms of treasury yields since the start of the year. So if you bet on treasuries, you've done well. If you bet on stocks, at least versus the rest of the world, you've done very poorly.
Yeah, this has certainly been a week, maybe a month of hiding. You have people getting into the bond market, partially because of the data, but also where else are you going to go? The Mag 7 has been a total drag. It hit correction territory this week. You have now consumer discretionary failing as well on investors. They were getting into the consumer trade at the end of last year. It's deeply negative now, Matt, because of all that weak consumer data we've been seeing.
I was 20 in 1994.
I was 4.
I was working at Generation Records downtown, just living a life of debauchery.
I was probably deeply trying to learn multiplication before school started.
All right, let's talk about the multiplication at 4. Let's talk about the Fed data that we got this morning. Some of it expected, some of it surprising, right?
Yeah, absolutely. We're going to bring in our Michael McKee for that because the PCE data was interesting. While the headline numbers hit expectations, Matt and I were looking at spending in particular. You don't see negative reads that often.
You let us down during the month. You weren't out there spending enough.
I didn't actually.
You were spending all your time with the mathematics instead of spending, but you're right. Spending was down negative 0.2 during the month after a revised 0.8 the month before. It takes off a little bit of the pain, but it does show consumers pulling back, and this follows what we've seen in the consumer sentiment numbers, and it is going to create a bit of a worry on Wall Street, probably for those consumer discretionary stocks, as you mentioned, and for the Fed, although it is, as they like to say, just 1 month's data. And personal income came in very strong. Wages and salaries were up 0.4. That's what they've been for the last couple of months. So it's not like we're losing any money here. Most of the big gain in personal income came in farm support payments, up 32%. Last year in January, they were up only 10%. 1.7%, though, increase in dividend payments. So if you're on Wall Street or on the farm, you were doing okay. You mentioned the price indexes. They came in line. Fed will look through that. Little progress being made. I want to move on to the trade balance, though. The trade balance that you mentioned, Matt. In 1994, I don't want to even say what age I was, but let's put it this way. Even at my age, I've never seen this, because this is the worst goods trade balance ever. You can see above that is the total trade balance. We get the services surplus next month. Next week takes off a little bit of that edge. But what this appears to be is companies buying stuff ahead of tariffs. Industrial goods supplies up 33% in the month. Consumer goods up 8.3%. People afraid of tariffs, they went out and bought while they could, which implies that the February trade data will go the other way. We'll get a rebound and it'll sort of balance out.
We ordered a case of maple syrup at my house.
That's probably, if you eat a lot of pancakes, waffles for the kids, yeah.
Mike, I want to get your take on the 10-year. I was out in Austin the last couple days riding motorcycles and just watching this yield drop. Why are we seeing the 10-year yield fall the way we are?
I can't give you an exact answer because there's two stories. One is that the economy is slowing and markets are preparing for what would be disinflation if we get a recession, or markets think that inflation is coming down, but the economy's okay, and you don't need to price for, you don't need to raise the term premium to get your money back. And nobody really knows at this point. That's the hard part about all this. As an economist and a Fed watcher, people who have to figure out what's going on, we welcome the asset world to our world these days of not knowing what's going on.
A little pricing action there. Mike McKee, thanks very much for that international policy and economics correspondent. Let's bring in Cantor Fitzgerald, Chief Equity and Macro Strategist Eric Johnson. He's here at the desk at 731 Lex with us. His 2025 price target for the S&P 500 is 6,000, which, Eric, looks pretty good today at 58.61, right? But it's not a whole lot of gain year to date. Why do you think stocks are essentially going nowhere this year?
Sure, and we think it's going to be extremely volatile throughout the year. I think ultimately go nowhere. One point is valuation. So valuations are at historic highs. The allocation to equities by individual investors also historic highs, and they've poured money. They've added on to that so far this year. And I think we're late cycle. So as we think about, where we are in the cycle, we've got unemployment rate is currently we're at full employment. We've had a, multi-year expansion. And if you look at the stock market relative to GDP, we are at, historic highs. We're actually higher than where we were in the internet bubble. So I think that makes for challenging returns going forward. And then, of course, in the short term, we do have some significant growth concerns.
That's fascinating. We talk about, which valuations to look at. I'm always looking at the CAPE ratio, but stock market levels versus GDP higher than we were in 2000.
Right. It's a nice reminder here that valuation can be calculated in a lot of ways.
Yes.
I want to go into some of the higher flyers where valuations stopped making sense for a long time, and that's the Magnificent Seven, where you've seen on valuation it correct now, just on price levels as well. I mean, 10% lower for the month. When you're talking about a market that is essentially going nowhere this year, how do you play this set of stocks that have been not only the market darlings, but also so much of the contributors to the market gains?
Absolutely. And really, it's been when you think about where individual investors have put their money over the last 4 years, a lot of it has gone into the Mag 7. There's a lot of embedded long exposure there. And if you look at some of the trends within the Mag 7, you have revenue growth that is starting to subside, revenue estimates that are going down. At the same time, cap spending is going up. And so that combination, I think investors are looking at, and for a group that is seen as capital light, that is a little bit concerning. I would also say the rate move. So these companies mostly have net cash. So they were benefiting, right, from yields going higher. As yields start to come in and the market starts to price in maybe more Fed cuts down the road, they get less of that benefit. And they're becoming a source of funds for investors to buy other securities, including more defensive equities.
Is there a rotation, though, really going on? I mean, the Mag 7 stocks not doing well, but 6,000 is still higher than we are today, right? So does that mean the S&P 493 does a little bit better? Do you like mid caps, small caps?
So I like the more defensive sectors and also healthcare, which you can sort of call defensive.
Which is defensive. So you like healthcare, utilities, telecoms.
Exactly. And I think, and that's for the next, sort of few months where, although our price target is 6,000, we think we're going down first. So to be clear, we think the next 2 to 3 months are going to be tricky time. We think we're going to get some sort of a washout within equities, and then of course we can bounce from there as the different puts that are out there, whether it's the Fed put or the Trump put, will kick in, and I think that can make for a much better second half of the year. Once the tax bill is passed and a lot of that uncertainty that we currently have goes down a significant amount.
I was looking at a lot of the indexes. If you're looking at the NASDAQ, you're down, for the 100, you're down more than 4% for the month already. For the SOX, the Philadelphia Semiconductor Index, you're down almost 7% for the month. The S&P 500 has been weak. The Magnificent Seven has been down more than 10%. How much do you look at flows here? Because if you're a hedge fund playing this market, I reckon you don't have a whole lot of dry powder to get into March with a lot of conviction. If you're a retail trader, you might have been burned by all of these levered ETFs this month.
That's right.
So what are you playing with heading into March?
If you're a retail trader, please don't buy levered ETFs.
That's what's been happening.
Correct.
That's what's been happening.
That's right. I mean, and momentum factor has gotten hit very hard. And a lot of these names are the high-flying, retail-owned names. And I think, hedge funds, their gross exposure coming in, as of a few weeks ago was towards the high. And so part of what you've seen is some degrossing as, volatility has gone up. If you have the same portfolio, but risk has just shot up, your overall risk without doing anything has gone up. So in order to mitigate that, you have to bring that down. And that's part of sort of the unwind that we've seen because momentum is a very crowded factor, right? People want to buy stocks, whether it's institutions or retail, stocks that are going higher. And so that has been, and that's really been a global phenomenon, right? You talk about, U.S. versus Europe and versus other parts of the world. I mean, this has been global dollars, right, have gone into the U.S. because our economy has been a major outperformer and because of the Mag 7. And so the process of unwinding that it takes time, right? Because it was a lot of years to get into it, and it doesn't just, get clean within a week, 2 weeks, or 3 weeks.
Well, you're not going to lose your job still for holding NVIDIA. Eric, you think, at least short term, the economy, the outlook has turned negative for the economy, and you like bonds, which has been a very good trade, as we've been showing, right? Does that continue, and flesh that out? Why is that? Because of spending cuts? Because the administration wants to get yields down?
So, a couple of reasons. So I think in terms of bond yields, around why I think they continue to move lower is, yes, you have the administration that wants a lower 10-year yield. And there are things that they can do from the Treasury, right, to move where they're issuing and do different creative things to get the 10-year yield down. So having them sort of on your side is one point. They're going after the deficit. So if you think about why bond yields were going to 480, 490, part of the concern was the expanding deficit, and is it just going to continue to expand? And then the third point is the growth slowdown. And so I think most of it right now is the growth slowdown, where bond yields are sort of going down for the wrong reason. And that's why you're seeing equity prices and bond yields be correlated and have a positive correlation where they're both moving lower. And, the growth outlook, you have companies where it's extremely uncertain what the environment is going to be. And so the economy is sort of going on pause a little bit with all these uncertainties around government spending, around tariffs, around the reconciliation bill, around the debt ceiling. And so this sort of pause in activity, I think, is going to filter ultimately down to earnings.
Eric, we thank you for joining us today, of course. That is Eric Johnson of Cantor Fitzgerald. We should have on our desk little shots of coffee for every time someone says tariff. What do you think?
I don't drink coffee, so I would be in major trouble if I, took like 14 shots. Yeah.
But also, I think we need to pull out the dictionary once more. We're going to be talking about recession fears a little more. You saw that in Apollo's Torsten Slott's note. The odds rising a little bit, Matt. Not that much, but they are rising. And stagflation, if you're worried about growth and you're worried about inflation, stagflation is a bit of a market killer. It's certainly a bond market killer as well.
Yeah, I mean, inflation doesn't seem like too much of a concern today because we see the PCE number coming down so low, 2.6% at the core year over year is pretty close to the Fed's target. But definitely growth concerns. And, Eric pointed out, if you take $2 trillion out of federal spending, that does a number on growth for sure. If you see futures today, though, we're still looking at gains, right? Okay, we had a big drop yesterday, and the Russell futures are down, but S&P futures up 0.2%. 15 minutes to the open. This is Bloomberg.
Is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have Take-Two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
I think one of the dirty little secrets of credit is that the businesses generally don't pay you back, right? The markets pay you back, M&A pays you back. So what is the most important thing is to always make sure that the borrower is worth more than the loan. And as long as the borrower is worth more than the loan, then it might be a rocky ride, but you're going to get your money back. And this world where there's these disruptive companies that have, let's call it 100, 200, 300 million of ARR, are looking to not raise equity capital because of the fact that they raised it in 2021 or 2022, and no one really wants a down round. But there's a lot of capacity in the capital structure to have, let's call it a structured solution. We think that there's a lot of opportunity with those businesses.
Loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
All right, let's get to high interest. Look at what's making headlines around the world. BlackRock is joining the latest Wall Street trend, scrapping DEI goals. The world's largest asset manager will abandon specific targets to increase the employee representation in its workforce. I guess, representation of underrepresented groups, and will no longer require hiring managers to interview a diverse slate of job candidates. BlackRock's move follows diversity U-turns by the biggest banks, pretty much all of them, including Goldman Sachs and Citi. By the way, Lauren Sanchez, the fiance of Jeff Bezos, whom you probably noticed at the inauguration, will fly to space on an upcoming all-women flight of Blue Origin's tourist rocket, which is owned, of course, by Bezos. Joining her will be pop star Katy Perry and TV personality Gayle King. The flight will mark the first all-female flight crew since a Soviet cosmonaut had a solo space flight in 1963. And our top trade story, Beijing is threatening to hit back at President Trump after he unveiled additional 10% tariffs on Chinese imports after doing 10% already in February. The additional levy will take effect on March 4th. Trump's new measures came without forewarning and took officials in both countries by surprise. A spokesperson for the Chinese Commerce Ministry said, if the U.S. insists on having its own way, China will counter with all necessary measures to defend its legitimate rights and interests. That's a direct quote, Janelle.
And certainly from the market's perspective, that March 4th date causing a bit of anxiety. So we're going to stay in Washington. Joining us now from the White House, Bloomberg's Tyler Kendall. Tyler, you think about the tit for tat that we're seeing up to that March 4th date. How is the White House considering what could become reciprocal?
Right. Hey, Sonali. Well, importantly, President Trump made this announcement about Chinese tariffs alongside his announcement confirming that he plans to implement 25% tariffs against Canada and Mexico on the same day. And we have to keep in mind, when it comes to this exact batch of tariff threats, they're really tied to some tangible policy priorities for this White House when it comes to immigration as well as fentanyl. We heard President Trump yesterday renew his accusations against Beijing for their role when it comes to drugs coming over the U.S. border illegally. And now Matt mentioned it there, Bloomberg News reporting that officials in both countries were really caught by surprise when it came to this, but it does continue what has been a recent trend from this administration to ramp up pressure on Beijing. Just in recent weeks, for example, we've seen the U.S. impose new investment curbs on Chinese investment, also propose heightened fees when it comes to Chinese vessels that are transporting U.S. goods. And then importantly, Sonali, just last week, Bloomberg reporting that U.S. officials asked Mexican officials to hike their own tariffs when it comes to Chinese goods.
Hey, in terms of the Ukraine war, Zelensky is in town. He's going to try and gain a little favor with Trump. Obviously, there's this mineral rights agreement that needs to be signed. What do we know?
Right. Well, the biggest question on the table right now, Matt, is security guarantees from the U.S., something Zelensky, as well as our European allies who were here at the White House this week, would like to see. But President Trump has said that he's really focused on this critical minerals deal. And we've heard the White House repeatedly say that those guarantees would really be implied because the U.S. would have a vested economic interest in the future of the country. So still those deals being worked out. President Trump has mostly sidestepped questions when it comes to security guarantees. So when Zelensky arrives here at 11 a.m. Eastern, followed by a 1 p.m. Eastern press conference, we'll see if some of those questions get answered.
All right, Tyler, thanks very much. Bloomberg's Tyler Kendall there in Washington. Going to be a busy day for her, as has been every day, I guess, since the president took office. Let's get a quick check on what's going on in futures. S&P futures continue to remain stronger. Just about 8 minutes to go until the start of the cash trade. I believe that's NASDAQ futures there that are down, but really unchanged. And then the Russell, the small caps, are falling.
It's hard to get excited about what you're seeing up there because you do have an S&P 500 that for the week is down 2.5% already. We're not going to erase that based on what futures are doing. And honestly, below 6,000 still. I think we missed you earlier this week when we fell below that level.
No. I was here. Remember, we talked about that. I think it was on Monday.
What week is it?
Exactly. Yeah, it's been pretty fascinating, the moves in stocks, but really bonds, and you can see at the bottom of the screen there, 424 right now, the 10-year yield. We'll continue to follow this for you as we bring you the market open. This is Bloomberg.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Middle East and Africa, vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
Bloomberg brings you breaking news 24 hours a day, powered by 2,900 journalists and analysts in more than 150 offices across the globe. Bloomberg Television. Context changes everything.
Welcome back to Bloomberg Open Interest. Looking at S&P futures that are still positive, as Shanali mentioned, you know, they've come down pretty substantially. If I look at you like this, it looks like I'm looking off screen, but I'm not because you're in
It
a
looks
different
cool,
position.
I think, Matt. You know, one thing that's been dragging down tech stocks is Tesla. It's lost almost all of its gains since the election in November. It's down more than 40% and on track from its highs and on track for its 7th day of losses. So if you count out Tesla, you're not doing as bad, actually. Well, coming up, stick with us less than 4 minutes to the opening bell. We're going to discuss the moves with Nadia Lovell. This is Bloomberg.
recent years, you created an institute, the Jane Goodall Institute, and what is that designed to do?
Well, that was started in 1977 when by then I had a little research station and 4 of my students were kidnapped and everything shut down. And so some friends of mine said, well, let's start an institute so that this research can carry on. Bless them. So that was 1977, and it was set up to study, conserve chimpanzees and other animals and educate. And it's developed since then. So it's, you know, we've got 27 Jane Goodall Institutes around the world. And then I realized at some point that the African people living in and around chimpanzee habitats right across Africa were struggling to survive. There was crippling poverty, lack of health and education, moving deeper into the forest, being exposed to diseases like Ebola and HIV from the chimpanzees and vice versa. It hit me. If we don't help these people to find ways of making a living without destroying their environment, conservation won't work.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
Bringing you up to the minute economic news whenever and wherever it happens. I'm Jennifer Zabasaja in Luanda, Angola, and this is Bloomberg.
We are moments away from the start of trading on the last day of the week. Thank God it's finally here. This is Bloomberg Open Interest. I'm Matt Miller. Take a look at futures. We're losing the gains that we had. Still a green arrow on S&P futures, but as Shanali pointed, we've seen a pretty serious drop already this week. We fell down through 6,000 on Monday, and we were off 1.5% yesterday. Red arrows on NASDAQ and Russell 2000 futures. You hear the bell ringing at the New York Stock Exchange. The U.S. Customs and Border Protection ringing the bell. There's a kid there having the time of his life. When they're not deporting people, they're opening the New York Stock Exchange for trade. And then at the NASDAQ market site, Rocket Pharma ringing the bell. To alleviate some of the stress, they've been down 25% this year. They were down 60% last year. They sold new shares in 2020 for $56, and they're trading for under 10. So it's been a rough ride, but that's life, I guess, in the pharma business. In terms of the major averages, we're looking at the live cash trade as the traders there in the NYSE open the market. We're looking at a flat trade on the S&P 500. NASDAQ down about 0.2%. Tech stocks really haven't been doing so great. We're going to talk to Caroline Hyde in just a moment. She sat down with Andy Jassy yesterday, so I'm excited to hear what she got from them. And then the small caps are down even worse, 0.4% on the Russell 2000. One stock to watch is Hewlett-Packard. It's actually just called HP now, but I feel like if I said that, no one would know what I'm talking about. HP's profit outlook fell short of expectations. Tariffs they cite as a problem, rising costs of components for the products that they make. They make, you know, printers and then other stuff. The company will cut up to 2,000 employees this year in an effort to save $300 million, and the shares are down almost 8% on the day. Shanali?
It's a sour way to end a sour week. It is kind of a bummer, isn't it? This is also kind of a bummer. Dell Technologies down 7% as the market opens. Now, they plan to ship $15 billion worth of AI servers this year, and that's a 50% jump from last year. And normally that would be very exciting, but investors are still concerned about the profitability of these products, and that's, of course, reflected in the move. We're going to look back at the week that was in the Magnificent Seven because it's been pretty brutal. Over a 5-day period, you're seeing it down more than 7%, barreling towards 8%. Tariffs, inflation, a potential economic slowdown is all hitting sentiment. Tesla, we have been talking about it all week, is hurting the most, down 30% this year. But if you look at this week, it's actually NVIDIA that's the worst performer, just above Tesla, if you can call it above. We're going to discuss the week in tech that was, bringing in Bloomberg Technology co-host Caroline Hyde, who has talked to so much of the C-suite and even more coming. What is going on?
We're all questioning the longevity of the AI hype cycle. And ultimately, when you get the return on AI investment, how much capacity is needed in the long term. And as you speak, really, Jensen Huang was trying to vindicate the fact that this new scaling law has arisen. The fact that we now have these reasoning models is still going to need a significant amount of compute power. But amid this context, the reason the whole market is under pressure at the moment, Shonali, is because of what's happening with the administration. What's happening in terms of the Chinese tariffs that are going to affect HP and certainly hitting some of their cost basis and why they're having to reduce people. We're seeing, of course, Dell speaking to some of the issues when it comes to the cost of goods that they're importing as well, and indeed the tariff implications. And what's interesting is it affects these chip makers. Now, just think about this AI diffusion rule. This is what was coming out yesterday. Microsoft trying to push back against what Biden put in place at the very end of his term, the idea that you can't sell very sophisticated chips, not only into China, but into allies, because it might end up in China. Now, I spoke with Andy Jassy just yesterday, asking him, look, is this an issue for you about the restrictions on selling on chips? Does it affect AWS? But he spoke more to the market. Just take a listen.
I don't know how this administration feels about it, but I would say that we share the concern that it has limitations on certain countries who are natural allies of the U.S., who just to be able to do their business and those companies to be able to get done what they want to get done on top of these technology infrastructure platforms like AWS, they're going to need more chips. And so I think if we don't do it, we're going to basically give up that business.
And what's interesting is that he's really optimistic about this administration, thinks it's one of the most business-friendly ones yet. He's spoken to President Trump, but ultimately they need some changes to be made here, Matt.
One problem, Caroline, I'm going to pick up here because in addition to Amazon, you're also speaking to the CEO of HP, and they are looking to cut up to 2,000 workers through October. All those American jobs that were supposed to be created on the heels of American productivity, where are they?
Well, it could be global in nature, and we don't know exactly where these cuts are coming. This is a company that makes a lot of products around the world. But you are right in terms of this is the efficiency. Look, I spoke to Andy Jassy about the delayering he's making of his own workforce. They've got to do more with less. And AI helps you with that as well, guys. But HP, as we're seeing them shift towards an AI PC mode, we are seeing people having to go. They're trying to think about protecting their margins. Margins under pressure because they're having higher cost of goods that they're importing, potential China tariffs on some of those, even though they've been changing their supply chains, and they have to get costs out from somewhere. And it comes to people. They've already stripped out so many jobs, so just adding to that.
All right, Caroline, I'm looking forward to your show. I know you got a lot coming. There's a Meta deal to get financing for massive investments in AI. So Caroline Hyde anchors Bloomberg Tech. That starts in just an hour and a half. And she will have the CEO of Hewlett-Packard on her program as well, Enrique Loris. Well, actually on our program. But she'll be joining us. So she's brought us the CEO.
Thanks for having me.
Thank you so much.
Thank you for being here.
Keep bringing us big CEOs. All right, joining us here at the desk at our headquarters is UBS Wealth Senior U.S. Equity Strategist Nadia Lovell. Nadia, great to have you here on the program. I feel like we're already so freaked out about tariffs that we're getting job cuts and market drops, especially when you look at compared to the rest of the world. U.S. stocks have had their worst start to a year since 1994, but it's only been like 5 weeks since Trump took office. So do we need to give him a little more time?
I think so. You know, I think what's causing, obviously, the range of outcome for tariffs is quite broad, right? We'll learn more in coming weeks, but our core view is that we do expect tariffs to go up. I think what's happening also is that tariffs is being used for non-trade related issues as well. You know, so far only the 10% is in place on China, but that's related to drug enforcement on fentanyl. We'll see what happens on Tuesday, you know, in terms of whether you get that 25% on Canada and Mexico.
Doesn't he have to do it, Nadia? I mean, he said he was going to do it last month. He gave them another month. If he keeps saying, I'm going to give you 25% tariffs and not doing it, isn't he then the boy who cried wolf?
Potentially, but even if you do get them, we don't think that they'll last. They'll probably be temporary because these tariffs, again, are related to non-trade issues. And the fact is that the supply chain is quite integrated within North America, particularly for industries like auto. And so we don't think that that would stick. But what we do expect to see an increase in terms of rhetoric and threats. You think the threats are happening now, but we think that they're going to increase after April 1st when those reports are due from the various federal agencies to address actual trade imbalances. So ultimately, we do think that you get higher tariffs, particularly around China. We think that you get an average of 30% after the second half of this year, and probably some selective tariffs on Europe as well.
On the heels of tariffs, a lot of people still worried about potential inflationary impacts of that. But even of what we've been seeing so far, we love to talk about what happened in tech this week, but what happened in consumer discretionary is equally alarming. The index itself is down 10% just this week. It's the worst performer in the S&P 500. Do you worry about the state of the consumer right now and whether it's screaming recession underneath the surface just a little bit? Do you start to worry?
We're not there yet, and we don't think that there's a recession. Of course, we continue to know that the lower-end consumer continues to struggle, and if we see increased tariffs, that could have a further impact on consumer spending, particularly on the lower end. But the high-end consumer is still hanging in there. The fact that you have a stock market that's still, yes, down 5% from its all-time high, but still doing well, particularly when you look at the sector level. And so we do think that consumer spending will rebound. Of course, we know that January is always a mix, the payback after December. I think also when you look at the consumer discretionary area, it's quite, it's dispersion under the hood. When you think about it, the fact is that you have a Tesla, as you mentioned, that's down quite a bit. Some of the cruise lines have been getting hit on threat of taxes on cruises. And so you will likely continue to see that dispersion within consumer discretionary. But ultimately, we think that the consumer as a whole is still in pretty good shape.
You are the equity strategist, but I think it's really important to watch these bond moves. I sit next to Shanali, so I hear about them constantly.
That's the first thing I say to him every morning.
Every morning. And look, we're down on the 2-year yield, almost 4 even. The 10 years at, I think, 4.24 right now. There you go, 4.24, 25. Is this good for stocks? I mean, certainly, if I think about buying a car or if I think about buying a house, I'm happy to see those yields come down.
It depends on why those yields are falling. I think that the bond market is probably signaling some growth concerns. And if it ultimately becomes that, then that's not great for stocks. We do ultimately think that the Fed will decrease interest rates this year, 2%, but that's going to be more driven by inflation coming down and less so by, growth meaningfully slow. We still expect growth to come in about 2%, so still pretty healthy economic growth. But the bond market has given false signals in the past, and we think right now what's pricing in is the uncertainty around tariffs and what that could do to growth.
Something that Eric Johnson over at Cantor Fitzgerald pointed out to us earlier in the hour was that lower bond yields for big tech stocks that have so much cash isn't great, because when rates were high, you were kind of accounting for that cash in the valuation. So who benefits as rates go down? Because you're not seeing it in the Russell. Where does it go?
Cui bono, Nadia, cui bono.
I think if the market moves beyond this uncertainty around government policy, it could be a huge benefit for the housing market, which we know has been somewhat paralyzed by the higher mortgage rates that we have seen. We know that Treasury Secretary has been, managing the long end of the curve and seeing that we want to see long end rates come down, and that could translate. We know that the 10 years mortgage rates is more correlated with the 10 years, so if we can see that come down, that could be a positive for the housing market. But I think we have to get through these tariffs concerns because the input to housing, lumber, comes from a portion of that comes from Canada.
I mean, think about all that you need to rebuild LA, right? You need construction workers. Well, we're shipping them out of the country. You need steel, 25% tariffs. You need lumber. A lot of that comes from Canada. I mean, it's going to be expensive and take a long, long time. Am I getting too off track?
No, you're
too off track.
We'll see how much this is bark versus bite.
Yeah.
Absolutely. Nadia, thank you for joining us here to end the week. Crazy week. Nadia Lovell of UBS Global Wealth Management. Now, coming up, we're going to get deeper into Tesla's tumble. We're going to take a look at what's driving the biggest slide among the Magnificent Seven stocks next. This is Bloomberg.
people, I think, from Homeland Security and or the CIA or NSA have gone to Capitol Hill and said that TikTok is a danger to our national security. But the public hasn't been given that much detailed information about what the threat is. How much of a threat to our national security is TikTok?
The People's Republic of China acts adversely to the interests of the United States in different ways. One of those ways is through the dissemination of disinformation, the intentional communication of false statements, and TikTok is an extraordinary avenue through which to disseminate disinformation to millions and millions of people.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
There is this real momentum from Wall Street. We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
David Weston. Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
It's done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
Time now for our top calls, some of the analyst action that we're focusing on this morning, and we'll kick it off with Bath and Body Works getting upgraded to a buy at Citi. The analyst says there's strong innovation in the Bath and Body Works pipeline. Next up is Vital Farms getting raised to a buy at Stifel. The analyst says the egg producer is well positioned for growth thanks to new farm acquisitions. Also, I've noticed that their prices are now becoming in line with just like regular mean egg producer prices. Finally, Walgreens is getting a downgrade to a sell at Deutsche Bank. The firm says reports of a potential take-private deal from Sycamore Partners will be tough to complete. And then, Shanali, Tesla investors are bracing for bad news. You've been talking about all morning long.
Yeah, this month alone, the stock has lost, as you're showing there, almost $400 billion in market cap. The dive is thanks in part to a slowing auto business and weak sales data. For more, we're joined on the future of Tesla by Bloomberg's Max Chafkin. He hosts the podcast Elon Inc. We're going to talk about the whole Elon world here for a moment, because Tesla, the slump you're seeing, on one hand, we've been making this point in the commercial break, what did investors expect to get for Tesla out of Elon Musk's relationship with the president?
Yeah, so two things going on. One is that Elon Musk has made this hard pivot away from the autos business towards what he calls full self-driving, robo-taxis. That business is very speculative, right? It's not clear when it's going to start to make money, when it's going to start to be real. They do not have a robo-taxi yet. The other thing that's going on is his political sort of antics in Washington is starting to alienate parts of Tesla's customer base. You think of a typical Tesla driver. This is like some upper middle class person who lives in the suburbs and cares about climate change, not necessarily likely to be impressed by like a, you know, pot stirring social media troll. So I think there's some of that going on. You're seeing it more dramatically in Europe than in the US, but you are seeing it a little bit in the US too, it seems.
Yeah, he's lost, what, 90 billion year to date. Will Shaker in the control room looking at his wealth for us. $90 billion year to date, which still makes him an incredibly wealthy person. Does he really care that much?
But does he make some of it up on some of the other enterprises? He's getting Starlink deals with the relationship to the FAA.
So worth saying, at least I last checked, he's still up since the election. I mean, I think it's no longer this insane increase, probably between 10 and 20% or something. And as you say, he is doing well. He is still wealthy, and he does have these other venues to increase his net worth. We've seen SpaceX's valuation is actually coming up quite a bit because and now it's a private company, so the dynamics aren't exactly the same, but there's a much clearer story of how does Elon Musk profit from his proximity to Trump. With Tesla, much less clear. I do think Elon Musk cares about Tesla's valuation, both because it's just who he is. He cares about the company, but also because he is not the most liquid person in the world. This stock is still an enormous part of how he's going to be able to finance other deals. If he wants to, start a seventh company, which you never know, he could do that, or do a buyout or something. So he is going to care about this. It's just not clear, I'd say, how much.
We talk about Elon Musk as though he's been distracted just by politics, but to your point on other companies, I don't know if you saw the scoop this week that we had.
Of course I saw it. I work here.
Well, you were driving hogs. Who knows?
I know, but it had a green bee, so yes. I look, that's not going to make up for the amount that he's lost at Tesla.
But the amount of influence and power
I think the power is key, and that seems to be, what he is high, at least one of the things that he's high on right now. So in terms of his actual job, his main focus right now should be cutting U.S. government spending.
Is that his main job?
I think so, yeah. Isn't it?
At the moment,
he's in Washington every single day, right? He goes to the White House every single day. He's not in Fremont. So if his main job is cutting government spending, is he really going to be successful in that endeavor when right now he's just sort of angering federal workers, which makes such a small percentage of the budget?
I mean, look, I think there are things that DOGE is doing that probably could be successful. It's just that when you're, as you say, Matt, like when you're going after the federal workforce, which is a very small part of the budget, plus, doing a lot of things where there's potential for litigation, for employees to be called back to work, for lots of ways in which this could sort of go sideways. The other thing I want to say is, as much as these companies are independent, their valuations are definitely linked. And you could, if Elon Musk, if Tesla falls dramatically, that could affect SpaceX's valuation because it also benefits from the Elon Musk aura, from the Elon Musk brand. All of these companies do, and we've seen all of their valuations go up. In the wake of the election, you could see the same trend in reverse. And I think ultimately, people talk about what could drive Trump and Elon apart. Is Trump going to get so mad at Elon Musk? I think a more likely outcome would be Elon Musk decides that this is hurting his companies, and it hasn't yet, right? Because even with Tesla's, even with what's been going on today, the stock is still relatively high, but it could, and you could see that lead to a political shift.
Thank you for always staying on it. A lot to watch in the Musk world. That is Max Chafkin of Bloomberg, and don't forget to catch his podcast, Elon Inc. I get frustrated here because you have Tesla as a publicly traded stock, but SpaceX and Starlink, because they're private, they're only available to only very wealthy investors.
Yeah, and it should be said, a lot of their business funded by much bigger, spending coffers in the U.S. government. Military spending is what you go after if you want to cut waste and fraud. Medicare and Medicaid spending is what you go after if you want to cut waste and fraud. I stop Max in the hallway and talk to him about this.
There's a lot to talk
every
about.
time I see him.
Anyways, yeah.
Last April, this is your wheelhouse, right? A city customer expected a $280 credit from the bank and instead got way more money than Elon Musk has, right?
$81 trillion. That is multiples more than Citi even moves in a day. We're going to talk about that next in the Wall Street Beat. This is Bloomberg.
up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at the Forbidden City in Beijing, and this is Bloomberg.
U.S. tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Now, Citigroup is back in the news for a massive credit error. Back in 2020, you might remember, it accidentally credited Revlon $900 million to its holders instead of $8 million, and it only got $500 million back. This time, Citigroup credited $81 trillion into a customer's account. It was supposed to be $280. This is all according to the Financial Times. It took 90 minutes to correct. No funds left the bank. We're going to discuss what's at stake with Bloomberg's chief Wall Street correspondent, Sridhar Natarajan. The problem here is being able to catch these mistakes. If I was Jane Fraser and I saw this down the road, it went through many hands, wouldn't I be saying WTF?
Look, this was bad. It wasn't Revlon bad because the client ultimately didn't get that amount over which Citi had to have a big fight. And in the end, ultimately, I do believe Citi got most of that money, if not all of that money back, but it was a long battle in the legal system. This one could have been quite bad, but at least it was caught. That's still not going to be any solace for regulators. And you're right. Therefore, the CEO, who's now 4 years into her tenure, 4 years into a tenure where she said solving the regulatory issues, improving risk management and data governance and data compliance is her top issue.
That's really what's at stake.
She will be frustrated.
Here.
Absolutely.
I mean, does this become a regulatory issue for these types of mistakes? $81 trillion on a piece of paper should be something bankers catch.
Look, let's play fantasy for a second. This client was supposed to get $280, was credited $81 trillion. However brief, not just more wealthier than Elon Musk, that's 3 times the size of the US GDP. That's more than the 10 top GDPs of 10 top countries combined. So that would have been a big error. So there's no way in the world that this would have actually gone through. But that's not the issue at hand, is it? Citi has come out with a statement where they've said, this is why we've been talking about the need to automate a lot of these processes, because it was a manual error in this case. But instead of $280, what if it was, instead of 81 trillion, what it was 2.8 million, 28 million? Would that have gone through? Could have gone through. And that's the issue. That's the problem that Citi has been battling. And the FT actually cites that the report to the regulators say in the last year, they've had 10 near misses of $1 billion plus payments. That's a problem, and they need to address it.
I would take that and peace out to Zug, Switzerland, like Mark Rich, so fast. Sri, thanks very much. Reminder, next week is Bloomberg Invest. We're going to be there live. More coming up. This is Bloomberg.
DraftKings hit a milestone in the second quarter of 2024. For the first time as a public company, it turned a profit.
this a new era for DraftKings?
There's an inflection from when you're cash flow negative and you're operating off of equity raises from the past to when you're self-funded and you're cash flow positive and able to control your destiny a lot more.
You've had your first quarters of profitability now. Does that take pressure off? Does it increase pressure?
I think it increases pressure. I mean, once you start making profits, people expect you to make more, and all of a sudden you're valued on a multiple of those profits as opposed to the theoretical what could be. So very important, I think.
When you're cash flow negative, you've sold a vision of what the company should be working on, and you're very focused on working on that and delivering against that. When you've pivoted to profitability, the world of what you can work on is a little bit open, and there's a lot of different ideas, and it requires more focus than ever to make sure that you are prioritizing on the most important things that are going to deliver the most value.
DraftKings' solid standing in a booming sector gives them the luxury to play the long game. They're not under pressure to cut costs.
When you have really strong revenue growth, you don't need that. If you look at where we are today and where we want to be and where we believe we will be, the vast majority of the incremental EBITDA is not coming from any cost reduction. It's coming from increased revenue.
We don't feel like we need to cut costs because we're growing our revenue so much. We want to grow our revenue into our existing cost structure, and there's no need to reduce the cost as long as we're being efficient with what we allow our cost growth to look like.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
News on the Hour, sponsored by Progressive Insurance.
I'm Deborah Rodriguez. As President Trump gets set to meet with Ukraine's Volodymyr Zelensky, we have breaking news from the White House on English. Multiple sources tell CBS News Mr. Trump is planning to sign an executive order making English the official language of the U.S. The country's never had one in its nearly 250-year history. The executive order would rescind a federal mandate issued by former President Clinton, requiring all agencies that receive federal funding to provide language assistance to non-English speakers. And out of that meeting between Mr. Trump and Volodymyr Zelensky, scheduled to get underway at the White House next hour, the two men are expected to sign an agreement on Ukraine's rare earth minerals in exchange for U.S. military aid. Correspondent Natalie Brand.
Ukraine, of course, wants security guarantees and wants to ensure continued, military support and assistance from the United States to deter against Russian aggression moving forward. Security guarantees, of course, a huge point that President Zelensky will be pushing.
Americans cut back drastically on spending last month, and even as inflation declined, they held off on saving what they made. Business analyst Jill Schlesinger.
Personal incomes and spending increased during the month, but perhaps because Americans think they'll need to beef up their cash reserves, the personal savings rate, that's the percentage of disposable income that Americans do not spend in a given month, rose to 4.6%. That's the highest rate since June of last year.
The 911 call from caretakers has been released after they discovered the decomposing remains of actor Gene Hackman, his wife, and their dog at their home in Santa Fe, New Mexico.
I think we just found one deceased person inside a house. They're not moving.
Investigators say the bodies were found in 3 separate rooms and there were no signs of a gas leak. Long before Slack, there was Skype.
Honey, who do we call? What do we do?
There's no way Haley's married.
It was used for an entire episode of ABC's Modern Family in 2015. Microsoft's just announced on X it is shutting down its online voice and video pioneer. The once tallest and fastest roller coaster in the world is a pile of rubble. Kingda Ka, which debuted 20 years ago, crashed to the ground in an implosion at Six Flags Great Adventure in Jackson Township, New Jersey this morning. It was retired last year to make room for new rides. Kingda Ka's speed record of 128 miles an hour was broken in 2010 by another coaster in Abu Dhabi that clocks 149 miles an hour. This is CBS News. Former world chess champ Boris Spassky has died.
Spassky became champion in 1969. He was arguably the greatest chess player of the Soviet era until he lost to American Bobby Fischer in 1972 in the match of the century. Spassky said he was happy to lose because his years as champion were the worst of his life.
I had very big obligations for chess life. I had to do many things for chess, but not for myself as a champion of the world.
In 1992, he lost a rematch with Fischer, who by then had become his friend. Boris Spassky was 88. Michael Wallace, CBS News.
Google's co-founder is so worried about keeping up with AI, he's ordered all workers back to the office at least 5 days a week. In a memo to employees who work on AI models and apps, the New York Times says Sergey Brin writes 60 hours a week is the sweet spot of productivity. Google's official return to office policy requires at least 3 days in a week. Deborah Rodriguez, CBS News.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been in U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Good Friday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience. We are streaming live on YouTube as well, so you can head over to youtube.com, search Bloomberg Podcast Live, and that's where you'll find us. Alex Steele's out today. Not to worry, the John Tucker is in studio. He's got us covered for the next couple hours, so we got a lot going on here. We're going to start off by going right down to Washington, D.C. A lot happening down in D.C. today. Tyler Kendall, Bloomberg News reporter. She'll give us the latest reporting from the White House. Peter Cheer, head of macro strategy at Academy Securities, get his thoughts on these markets. Woo Jin Ho, Bloomberg Intelligence senior technology analyst. He's going to recap some of the earnings we saw coming out of Dell and HP as well. Craig Trudell's also going to join us. Global Autos editor. Nissan needs rescuing again, and it's running out of options. We'll talk about Nissan and the global auto business. A lot coming up in this hour. Stay with us. Let's kick it all off with Lisa Mateo and get a Bloomberg Business Flash.
And this Bloomberg Business Flash brought to you by IBKR. Will the average U.S. temperature in February 2025 exceed 36 degrees Fahrenheit? At IBKR Forecast Trader, the yes recently at 44%. What's your take? You can trade your prediction at ibkr.com/forecast. All right, we've got stocks mix, and this is after some relief on the inflation front. The Fed's favorite inflation gauge rose at a mild pace in January. So let's get right to it. The core PCE price index rose 0.3% from December, 2.6% from a year ago. Consumers did pull back in spending, falling about 0.5%, marking the biggest monthly decline in almost 4 years. Other economic news coming in, the U.S. merchandise trade deficit, well, that widened unexpectedly, 25.6% to a record in January. Imports surged ahead of President Trump's expected tariffs. Now to the markets. NASDAQ, little change, down about 3 points. The Dow up about 0.5%, 247 points. The S&P 500 up 0.2% or 16 points. The 2-year yield, 4.03%, down 1 basis point. The yield on the 10-year, 4.23%, and that's down 2 basis points. Bitcoin, it fell as much as 7.1% this morning. It's now down about 1%, just over 1.5%. It's at 82,000. Earlier, crypto-related stocks were lower before the bell. Now we're starting to see a change. So you have Coinbase up about 0.6%, Riot up, platforms up about 3%, even MicroStrategy up about 2.5%. What is still falling? Well, that's shares of NVIDIA right now. They're down about 0.2%. They fell 8.5% yesterday. And finally, Tesla trying to avoid falling to a 7th session in a row. Right now, it's up about 0.3%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now, wherever you get your podcasts. I'm Lisa Mateo. That is a Bloomberg Business Flash. Paul and John.
Hi, Lisa Mateo. Thank you so much. We appreciate that. The John Tucker sitting in for Alex Steele. I'm Paul Sweeney live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube. We did hear from Alex. She had a little minor medical thing this morning. Everything's cool. So
and she said it was okay to discuss her medical issues on the air?
Well, I didn't say medical issues. I just said you had to broadly define, but she was in a cab, and guess what the cab's listening to? Bloomberg Radio.
Because the radio's broken?
I don't know. Exactly. There you go. So we got some good stuff going on out there. All right, for our 3 people in our audience that are University of Virginia basketball fans, they are bad. I mean, UVA, it's almost
I should point out to people on the radio, you're wearing your Duke.
I am wearing my...
Is there a big game this weekend?
No, just another day in the life of a Duke Hoops fan. We're going to win it all this year, but Virginia's bad. They're 14-14. They play Clemson this weekend. Emily Grafeo, you're a Virginia Cavalier. What's going on down there?
It's been really depressing. We lost our coach, Tony Bennett.
Yes.
I've been kind of like shielding my eyes from the TV. I mean, listen, I'm still a proud Wahoo.
All right.
We'll make it next year.
All right, what's going on in the marketplace out there, Emily? We're seeing a little bit of green on the screen. We're mixed through the morning, but now we've got a little bit of a lift here with the S&P up 17 points. What stocks are you looking at?
I mean, there is some movement under the hood here. I'm looking at Monster Beverage because those shares were up as much as 8.6%. It was the biggest jump since 2023. Better than expected margin, according to their earnings report. So this is an energy drink maker, which I feel like we talk about a lot. We talked about Celsius.
Can you use it as a mixer?
The kids use it in a bar. What do they put in with the Monster?
Well, usually it's a Red Bull.
Oh,
vodka.
Red Bull. Okay, Red Bull.
Yeah.
What do you mix with Red Bull? Like vodka?
Yeah, and then you kind of combine it. That's not my drink of choice, I will say. But I have witnessed people.
Your demo does that.
Drinking that.
Yes, okay.
Yes, I guess my demo does
yes.
that.
All right.
But yeah, I mean, net sales up 4.7% year over year. The adjusted EPS, it missed. But again, that stock is pretty much just a vertical line up when you look at the chart. I'm also looking at shares of HP falling. It was down 4% at one point. I guess their earnings were just not as good. They said that the hardware manufacturer forecast second quarter adjusted earnings per share between 75 and 85 cents. Analysts expected 85. It's kind of a mixed bag this earnings season. That's now down 7%.
They're making the servers, the AI servers, so they have to buy the chips from NVIDIA, and they're not cheap. So I guess that weighs on the margins.
Maybe they should be buying the DeepSeek programs. Maybe that would, if we could advise.
Well, we're going to have Wu Jin Ho on from Bloomberg
controversial.
Intelligence. He covers Dell and HP, so he'll give us the breakdown there. What else you got?
Okay, I'm also looking at Walgreens because those shares were down as much as 6.7%. And earlier in the day, there was a downgrade at Deutsche Bank.
To a sell? That's a rare.
To a cut. Walgreens. Yeah. Well, it was downgraded to sell from hold. They said that reports of a potential take-private deal from Sycamore Partners could be very tough to complete. And then just about half an hour ago, we got news from CNBC. Well, shout out them. They said that Sycamore's closing in on a buyout of Walgreens, but the shares are still down.
And the Walgreens they built in Middletown on Route 35, they're brand new Walmart, Walgreens, and it was like just a year or two later. Now it's vacant.
Is that right?
Yeah.
That's not good. All
Never
right.
a good sign.
Well, you can't buy anything at the Walgreens.
In Manhattan.
Because
they're all locked up.
Yeah.
Don't get Matt Miller going on that. That's crazy.
I'd love to be a customer, but...
Exactly. All right, Emily Grafeo, thank you so much. We appreciate that. Emily Grafeo, she is a Bloomberg cross-asset reporter, giving us the breakdown on the market. Let's head down to Washington, D.C., check in with Tyler Kendall. She's a reporter for Bloomberg News. She's in the White House. Big day at the White House. Every day seems to be a big day, Tyler. One world leader after another coming to see President Trump. Today it is President Zelensky from Ukraine. What's the latest reporting on that?
Yeah, hey there. So I'm not sure if you can still see it behind me, but there is an honor guard lined up for our radio listeners. They are holding all 50 flags of the United States as they get ready to welcome Zelensky here to the White House. He's expected at 11 a.m. Eastern. Yeah, you might be able to hear the echo of them, of their commands as they get ready for this official visit. We saw very similar things earlier this week when Emmanuel Macron and, of course, UK Prime Minister Keir Starmer were here. And even after those visits, still the big question today is whether or not President Trump will commit to U.S. security guarantees when it comes to Ukraine. We know a big focus is going to be signing this critical minerals deal. And President Trump has repeatedly said, as well as other White House officials, that they really view that deal as having implicit guarantees for Ukraine because the U.S. would have a vested economic interest. But we know that Zelensky and our European allies would like to see those tangible commitments go a little farther.
Yeah, Tyler, in the old neighborhood, there was a guy every month who'd come around and collect protection money. This minerals deal, is anybody calling it extortion?
I haven't heard it quite put like that, but
I'm
really
blunt,
Ukraine.
Tyler.
Really, Ukraine would like to see those firmer security commitments. And we're hearing President Trump talk a lot about rare earth minerals. Important to note that Ukraine really has critical minerals. Rare earth minerals are a subset of that. Critical minerals like titanium is something that the U.S. is hoping to get out of this deal. Also, in these reserves is going to be revenues from oil and gas, so that is contributing to the math here. But President Trump has really said that he's trying to get back on U.S. investment. But important that Zelensky repeatedly affirms that the conditions he negotiated for this aid under the last administration does not amount to a debt that needs to be paid. And I just looked up recently the numbers. The U.S. Congress has appropriated $174 billion for Ukraine so far. $84 billion of that has actually been dispersed. Those numbers are more in line with what Zelensky says that he has been tracking, whereas we've heard the White House put those costs a lot higher.
Tyler, is there an expectation at the White House today that there will be any type of formal agreement at the end of the meeting between Zelensky and Trump, or is that not an expectation?
Well, our reporting indicates that they are moving ahead with this critical minerals deal, and President Trump has said that he doesn't want to talk about any sort of U.S. security guarantees until both that deal is signed, but also a broader peace deal is signed between Ukraine and Russia. And we're really starting to get these updates fast and furious. I mentioned, of course, the French President Emmanuel Macron was here, UK Prime Minister Keir Starmer, but notably, neither one of them really left with concrete promises or guarantees from this White House, particularly as they both have floated that they are interested in sending European peacekeepers on the ground, but they say that they would like to see the U.S. underwrite that effort, something that President Trump has sidestepped questions when it comes to that.
Is President Zelensky still a dictator?
Well, President Trump did walk back his comments yesterday, saying that he didn't say that. We should say that he did say that, also said it on Truth Social, but sort of this toning down in rhetoric comes ahead of this meeting today as they try to get this critical minerals deal signed after reporting indicated that maybe it was up in the air, particularly after the Ukrainians wanted to make sure that their share of the deal was better represented so that it was a 50-50 split when it came to revenue out of this resource pot that they are establishing. So President Trump taking a lighter tone when it came to that, particularly after meeting with UK Prime Minister Keir Starmer, where we know that he was starting to be appeased when it came to some promises from our European allies, such as Keir Starmer saying that Europe would, for example, up its security assistance to Ukraine, as well as up its own defense spending as part of its GDP. Two things that President Trump wanted to see happen from our European allies, so perhaps that could have fed into his shifting rhetoric.
Tyler, thank you so much.
Yesterday.
Very good. Tyler, thank you so much for your reporting. We appreciate that. Tyler Kendall, she's a reporter for Bloomberg News, reporting today live from the White House. Again, President Zelensky, Ukraine set to arrive at approximately 11 a.m. East Coast time for critical talks with President Trump as President Trump attempts to move both Ukraine and Russia to the negotiating table. I guess another big data point, John, will be when will President Trump meet with President Putin presumably as a next step here.
And does this mean President Zelensky and Ukraine are now actually part of the peace talks?
Will actually be at the table. Interesting. And regarding that rare earth minerals deal, I recommend people take a look at Javier Blas's opinion column on Bloomberg Terminal. He's the expert in this stuff, and he says basically Ukraine doesn't really have any of these, super rare earth minerals. So take a look at that. All right, folks. New for Bloomberg.com subscribers, get the Going Private newsletter. It's delivered right to your inbox Wednesdays and Fridays, bringing you coverage of private markets and the forces moving capital away from the public eye. Subscribe to the Going Private newsletter now at Bloomberg.com/Going Private. Coming up, we're going to check in with Peter Cheer. He's over the head of macro strategy at Academy Securities to get his thoughts on these markets. Again, we've got S&P up 17 points. This is Bloomberg.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
From the Bloomberg Interactive Broker Studio, I'm Lisa Matei. Well, after a string of suggested price pressures heating up again, some relief after the Fed's preferred inflation gauge rises at a mild pace. So what we want to do is get to stocks. NASDAQ up 0.1%, 31 points. We have the Dow up 0.4%, and we have the S&P 500. That's up about 0.2%. We get over to the 2-year yield, 4.04%. That's little change. The yield on the 10-year, 4.24%, and that's down 1 basis point. To commodities, right now we have spot gold, $2,840 an ounce. That's down about 1%. Brent crude down more than 1%, $73 a barrel. WTI crude, $69 a barrel. And we go over to the Bloomberg Dollar Spot Index, up about 0.1%. Bitcoin down about 0.6% at just above 83,000. Few companies making news. Meta said to be in talks with Apollo for a $35 billion financing package. It's to help develop data centers in the U.S. Sources say KKR could be involved in that as well. Microsoft also in the headlines, closing Skype. It comes 14 years after buying it for $8.5 billion. It's going to happen in May. Users are going to have that option to change over to Teams. And finally, another use for AI, Teleperformance. That's the largest call center operator in the world. It's telling Bloomberg it's rolling out an AI system that it says will soften English-speaking Indian workers' accents to make them a little bit more understandable. It also said it's going to cancel out the background noise as well. But this Bloomberg Flash, it was brought to you by Oracle. Attention, growing businesses. Oracle offering to cut your current cloud bill in half if you move to Oracle Cloud Infrastructure. For new U.S. customers with minimum financial commitment, offer ends March 31st. See if your company qualifies at oracle.com/Bloomberg.
I always ask those, where are you? I am blah, blah. And they'll never say, like, in
Where
India or
like
Mumbai, usually it is. But it's just like, I usually get to force them to tell me. I do it nicely.
Yeah, exactly. You see what it's a global business. It's a global economy. All right, very good. All right. Lisa Mateo, thank you so much. We appreciate that. John Tucker sitting in for Alex Steele. I'm Paul Sweeney, live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube. Head over to youtube.com, search Bloomberg Podcast Live, and that's where you'll find us. Like most investors, I think we're all just trying to, kind of sift our way through all the news that's out there, particularly coming out of Washington, fast and furious. And what does it all mean for markets when you try to find the stuff that really matters? We had some economic data today. We have earnings, of course, finishing up, but we've got a lot of news coming out of Washington and other parts of the world. Peter Cheer, he's head of macro strategy. He tries to do this as well. He's at Academy Securities. Peter, what do you tell your clients on kind of how to navigate through a lot of the noise that's out there in the marketplace?
I think we're, trying to figure out what's the theme that's coming out of this administration. That's still a little bit unclear. And then, okay, what can we ignore? And more, I think where we're getting stuck at is basically, even if you believe we're going to have good outcomes, or you might believe we're going to have bad outcomes, I don't see how we don't go through a bumpy patch first. So that's kind of my current view, is everything that's going on is going to lead to a slowdown in the economy, either because we do things to the economy, or because of the threats of what we might do. It slows the economy down as people kind of put themselves on wait and see. So I'm now a little bit bearish on the economy, and I think markets because of that.
Lisa just gave us the Bitcoin quote. It's right now, down 0.3%. It's around 84,000 per token, which is kind of a precipitous drop from the high. What, if any, risk does crypto pose to stocks, my stock portfolio?
I think it has been posing a greater risk than it used to. One, there's always the wealth effect. So I think the wealth effect is real. So if crypto continues to go down and all the altcoins, which have been hit particularly hard, you'll have a wealth effect. But the other thing is, I think really since the advent of the ETFs, you used to have people who were in crypto and they held it, say, in cold storage, or maybe they held it at Coinbase. Now they might have it in their, Fidelity, Schwab, wherever you do your brokerage account, and it's mixed in. So I think when they see their crypto ETFs go down, it makes them respond and possibly sell everything. So that's one part that's very different from even a year ago. And the second part is that MSTR itself, one, they become even more wed and tied to crypto, right? Every single day they talk about their Bitcoin yield, whatever that is, how much crypto they have. So they become very tied to that, and they got included in the NASDAQ 100. So they're only about a 0.4% weighting, about the 50th stock in the NASDAQ 100, but it is now a direct tie into the NASDAQ 100. So I think the correlation and the linkage is higher, and I don't like what I'm seeing in crypto, and I think that's going to continue to drag on stocks for the next few weeks.
So, Peter, we've had a little bit of a pullback here from the peak, call it 4% here. Do we have more to go, do you think, at least in the short term, until maybe the market gets a little bit more comfort with this administration and some of the economic policies?
Yeah, I do think we have more to come. You know, we might get a little bounce today. We might get some good news out of Zelensky. You know, Trump might say that delivering the cartel prisoners to the U.S. gets Mexico another stay of execution on tariffs. But I think we are going to go back almost across the board to pre-election levels. You've already seen that hit certain cryptocurrencies. I think Ethereum is back to levels from before then. It hasn't hit Bitcoin yet. I think that's coming. In the stock market, the Russell 2000's back pre-election levels. We're not there in the S&P 500 or NASDAQ 100 yet, but I think that's where we're headed, unfortunately.
Let's talk Fed. 2 cuts, I believe, are priced in right now, if the markets are correct. Is that enough?
I'm beginning to think not. I would say start of the year, I was thinking 1 to 2 cuts. I did not think we make much progress on the deficit. I'm still not sure we will make much progress on the deficit. Having said that, I do think the economy is slowing faster. And again, you know, we just talked about some of the issues with tariffs and how I think we go through a bumpy patch. When you look at what Doge is trying to do, it's going to cut some spending. That's going to hit immediately. Whether some of it was inefficient, fine, maybe that doesn't have an impact. But to the extent they trim anything that was efficiently being allocated, that hits. And then the jobs, even if people get laid off, are able to find jobs, which I'm questioning because I don't think the market's that great for jobs. It is still going to be this transition period. So I think we're going to see economic data hit across the board, and we're starting to watch delinquencies rise across the board. I think this economy is much more susceptible to a pullback than we have talked about for a while. So I think we're going to see 3 to 4 cuts this year, and we're going to start hearing the recession word rear its head again in the next few weeks.
Interesting. All right, given that backdrop, Peter, fixed income, how you playing the bond market these days?
You know, and I was bearish in the bond market. I thought we could get to 480. It wasn't aggressive, and we've been trying to time it. I've capitulated on that. I think the bond market, 4 to 4.25% on 10s, mostly because I really capitulated on the state of the economy. I thought we'd have a smoother transition with Trump. I think there'd be more clarity. It's the lack of clarity that's kind of confusing me. So I think yields are going to be okay. I think credit spreads start widening. I do like the municipal bond market for a lot of our clients, on the retail side of things when we talk about it. But as a whole, I think credit's going to be okay. I am, for the first time in, probably a year and a half, a little bit nervous about credit spreads. So I've been very calm about credit spreads. I think we're going to see some widening, if I'm right, on what's going on in the economy and further pullbacks in stock market.
Peter, thanks so much for joining us. Really appreciate it. Peter Cheer, he's head of macro strategy at Academy Securities here. Looking on the earnings front, we've had some of those computer hardware folks report numbers. Dell, Hewlett-Packard, some different movements in the stocks here. Let's break it down with Woo Jin Ho. Woo Jin Ho, Bloomberg Intelligence Senior Technology Analyst. Woo, let's start with our good friend Michael Dell there. Talk to us about what's happening at Dell, because that stock's had a nice run. What are we seeing there?
Yeah, hey Paul. So a couple of things are going on here. There's a good and also a bad, but quite frankly, I think it's more on the good side. They actually, fell short of consensus expectations, primarily because AI servers fell short. However, they gave this whopping $15 billion AI server number for fiscal 2026 or calendar 2025. That's up 50%, 50% on a year-on-year basis. So if you think about it, let me put this in context. That AI server number went from 0 3 years ago, and it went up to 15 billion in 2025. So if the issue is that they're not as profitable, and it is eating away on gross margins, and that's not satisfactory to investors, it seems.
Their AI servers are not as profitable. I mean, why? Because they have to use expensive chips?
Yeah, good question, John. I mean, there's a couple of things, right? We're getting GPUs from NVIDIA, so the chips are fairly expensive. That's one. Number two, these are big whale deals, right? We're talking about, I think one of our Bloomberg News reporters did this fantastic report, had some fantastic reporting with, there's an XAI deal worth $5 billion. So there's going to be a lot of discounting on that particular deal. And he also followed that up with gross margins of 5%. Keep in mind, traditional server gross margins are in the high teens, low 20s. So just for Michael Dell to win this deal, he's giving a fairly hefty discount, just to get that footprint in there.
Talk to us about Hewlett-Packard. What are you hearing from them?
Yeah, not a fan of Hewlett-Packard's print. I know that they reaffirmed their guidance of 345 to 375. They're doing a couple of things in trying to get to that number. One, look, the AIPC business is actually doing a lot better than I thought they'd be doing. Clearly better than what Dell is doing. However, there's some tariff headwinds, right? They think they've mitigated some of that by maneuvering their supply chain around. Also, they're cutting costs. And I've never been a big fan of cost cutting to get to EPS in order to pay their shareholders, right? Now, the tariff maneuvering was as of probably 2-3 days ago, and we know that there's a lot of uncertainty of more tariffs. So if there are more tariffs, the low end of that 345 to 375 EPS is at risk in our view.
Now, with Dell and HP and their businesses and the stuff that they sell, how much of that is commoditized?
No, a lot of it is commoditized, John, right?
And the implications of that.
Yeah, there's a couple of things, right? If we look at the traditional PC market, that's never been a high growth market, but there are a couple of things that are supposed to drive faster growth. One, there's a Windows 11 upgrade cycle that's coming online. And also, number two, you have AI PCs coming online. That might not drive a much stronger unit growth, but it is going to drive ASP growth, pricing, incremental pricing increases, right? So if we think of what Dell, HP is trying to do, there's a little bit more wiggle room in terms of driving higher prices to drive growth. Dell just doesn't have that luxury because they are a premium product. But all in all, let's think of it as a mid-single-digit growth industry.
All right, Woo Jin Ho, thank you so much. We appreciate that. Woo Jin Ho covers the tech space for Bloomberg Intelligence, part of the global technology research team at Bloomberg Intelligence. We've got analysts all over the world covering the global technology space, hardware, software, the whole thing. So they're one of the best teams on the street. Looking at Dell here after their earnings, stock's off 5.5% today, off 11% year to date, and on a trailing 12-month basis, it is up 7%. It's got a market cap of $71 billion, and Michael Dell owns a lot of it. And
Michael Dell also, I think he's the 4th or 5th richest person.
Yeah, I mean, you can go. We have a function, believe it or not, on the Bloomberg terminal. Rich Go, R-I-C-H Go, and Michael Dell is on that list. It's coming up slow. Here we go, Michael Dell. Boy, he's number 14, $112 billion. That's the good news. The bad news, he's down about $11 billion year to date, but still north of $100 billion. We'll have more coming up. This is Bloomberg. Good morning.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
From the Bloomberg Interactive Broker Studio, I'm Lisa Mateo. Well, we've got stocks. We're seeing a bit of a lift. It comes more as more of the Mag 7 stocks kind of creep higher. Earlier, most were in the red, but now we have, for example, we have Tesla up more than 2.5%, NVIDIA up more than 1.5%. So we go to the NASDAQ, up about 0.5%, 94 points. The S&P 500 up 0.5%, 30 points. And the Dow up 0.5% or 242 points. The two-year yield, 4.05%. That's little change. And the yield on the 10-year, 4.25%. And that is little change. The Bloomberg Dollar Spot Index, little change. And Bitcoin improving a bit after falling more than 7% before the bell. It's now down about 0.5%, just over 83,000. Shares of Dell, well, they're lower. They're down about 6.5% after its sales outlook for AI servers. It really failed to help alleviate those concerns about profitability. Then we go to HP. Its outlook missed, rising component costs, tariffs on goods from China. But it also said it's going to cut about 1,000 to 2,000 workers through the end of the fiscal year. That's going to save an additional roughly $300 million per year. Those shares are up about 0.5%. And finally, energy drink maker Monster Beverage, their shares up more than 5.5%. Fourth quarter gross margin topped estimates. On top of that, net sales, they were also in line with expectations. For on-demand news 24 hours a day, subscribe to Bloomberg News Now, wherever you get your podcasts. I'm Lisa Mateo. That is a Bloomberg Business Flash. Paul and John.
All right, Lisa Mateo, thank you so much. We appreciate that. John Tucker sitting in for Alex Steele. I'm Paul Swinney. We're live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube. So you just have to go to youtube.com, search Bloomberg Podcast Live, and that's where you'll find us. The big take story today is an auto story. It is on Nissan. Great headline. Nissan needs rescuing again and is running out of options. One of the authors of that story joins us right now. Craig Trudell, Global Autos Editor for Bloomberg News from London here. Craig, talk to us about Nissan. It seems like, I don't know, a long time ago, they were still in trouble, and it was Renault, the French auto company, that came to the rescue. But we know what happened there. They're no longer together. What's happening at Nissan these days?
Yeah, they're sort of clinging to that alliance with their fingernails at this point. We're about 26 years in, and you know it feels like history. If it's not repeating, it's rhyming, right? Where you know, at that point back in 1999, Nissan was really you know, on its back. Renault swooped in, brought in a up and coming executive named Carlos Ghosn, who made quite a name for himself. Unfortunately, we've had nothing but you know, really tumult and chaos at the company. Really, you know, I think you could even say preceding Ghosn's takedown and his arrest in Japan, but really it only intensified after that. And this is a company that has been without you know, steady and credible leadership, I would say. But also just really struggling in a lot of its core markets. In China, you know, it was early to the electric vehicle game, but it is being beat pretty soundly in that regard. And in the U.S., you know, of course, EV take-up hasn't been nearly as quick, but Americans are buying an awful lot of hybrid cars. Toyota has those in you know, virtually all segments, and Nissan is pretty much absent. So I would say those markets in particular have been the big bugaboos for this company.
Why don't they just restructure?
They've been trying to do that, but I think an emphasis on trying. You know, there have been you know, some you know, there's been a fair amount of pressure put on the current CEO, you know, Makoto Uchida, to really come up with turnaround plans. I think there's been a mix of maybe a lack of ambition there, but also, and I think more so than that, just a lack of execution, where you have not seen the company make the difficult decisions that it needs to make in terms of you know, dismissing workers. They likely need to close plants. I think it took you know, a couple of plants for them to come around to the idea that, you know what, yes, we will have to shut some factories. And this is, you know, this is, I would say, still a case of a company that is not yet, you know, by any means hemorrhaging money, but virtually everything is trending in the wrong direction for them.
So talk to us about China here and some of the competitive threats from these Chinese automakers that seem to be taking over the EV and to a lesser extent the hybrid market on a global scale. How is Nissan dealing with those folks?
Yeah, I mean, BYD, of course, is sort of a cut above of everybody else, especially, I would say, in the fully electric vehicle space. But to your point, they also, I think it's, maybe underappreciated how much they've really, accelerated just in the last year or so from a plug-in hybrid, perspective. And, extended range hybrids, which, I think is still a little bit jargony for most people who aren't big car buffs. But if you think back to the Chevrolet Volt, a vehicle where you didn't have to plug it in if you don't need to, and yet you're sort of, it'd be smart to do so because it's cheaper for you to operate. That has proved to be an extremely attractive offering with consumers in China because it sort of does away with range anxiety. You do get substantial range out of them. And I would say, Nissan is far from alone in being, all but absent in that regard. That segment is completely dominated by the Chinese players. And Western car makers, Nissan included, just have not had an answer for that. They've been really caught flat-footed.
And if they make a $10,000 EV, I think I'm in. I'll pull the trigger on that one. What's the timeline here? I mean, they're facing, I guess they have debt coming due. How soon do they have to do something?
Yeah, I think, this is a case where the Japanese government, I think, is playing a big role behind the scenes. The METI, the Ministry of Economy, is really asserting itself and concerned about the sort of long-term future of Nissan. As you mentioned, they do have, quite a bit of debt coming due next year. That is likely to sort of add to pressure here. But I think, more so than anything, I would expect the Japanese government to really assert itself. I think they, tried to do that and to some degree drive Nissan into Honda's arms. And we saw late last year the companies agree to have talks about combining under a holding company. I think what probably contributed to that, not going very far and really sort of falling apart quickly is that Honda is so much better off as a company, so much more valuable, so much better run, and in such better shape that, I think Nissan is probably going to have to swallow its pride and consider options that might not be, might not be ideal for them. But if it means selling outright to Honda and, essentially agreeing to a rescue, that is probably seems to me like an option that the company at least has to consider at this point.
I saw in your story KKR might have an interest. That kind of surprised me.
Yes, I think there's been some sort of attempts on the part of private equity to go into Japan. I think it is a pretty tricky place for Western private equity players to come in, especially with an employer that is so important to the Japanese economy and that the government is quite sensitive to. So, I would be a bit surprised to see that. I think, one of the things that is mentioned toward the end of our story today is that, rather than sort of seeking control, our sense is that KKR is more, more inclined here to sort of protect its investment in a big Nissan supplier called Morelli Holdings. So it may not necessarily be the case that this is an out-and-out sort of new owner where, we'll see like a Cerberus Chrysler type situation.
All right, good stuff. Craig, thanks so much for joining us. Craig Trudell, he's a global autos editor for Bloomberg News. He's based in London with a big take story out there today on Nissan. Still looking for some help out there, looking for potentially a new CEO. And you can read more of this story on the Bloomberg terminal as well as on Bloomberg.com/big take here. Looking at the markets here, we do have some green on the screen. We're holding on. S&P's up 25 points, 0.4%. The Nasdaq's about 0.9 of the way higher as well here. So we got a little bit of green on the screen. Coming up, we're going to check in with Mandeep Singh, Bloomberg Intelligence Senior Tech Industry Analyst. Let's see what's happening in the world of technology. I saw that Skype going away.
That's
Skype,
gone.
Yeah, I mean, that kind of got me by surprise because that was it for a while. This is Bloomberg. Good morning.
listening to Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
All right, John Tucker sitting in for Alex Steele. I'm Paul Sweeney. We are live here in our Bloomberg Interactive Broker studio. We're streaming live on YouTube as well. Let's get a roundup of what's going on in the world of technology. Nobody better than Mandeep Singh, Senior Technology Analyst for Bloomberg Intelligence. Mandeep, I want to go to this story I just saw. It kind of goes with our good friends over there at Facebook/Meta. Meta's in talks with Apollo. That's the private credit company Apollo for $35 billion data center financing. What's going on there?
Well, I mean, we know all these companies are looking to spend more on, data center expansion this year. It's reflected in their CapEx views. And I think with Meta, they don't want to do it all by themselves. So when you think about, setting up an AI data center, it's not just the AI chips that obviously is the main cost within the data center, but also, procuring the land, thinking about the cooling infrastructure, getting the power, which has been a big constraint, and no better partner than, some of these private equity guys like Apollo. So it makes a lot of strategic sense that, even though Meta has a $60 to $65 billion CapEx budget for 2025, they're getting this additional funding from Apollo and really partnering with them to set up this new AI data center, which it looks like they're very keen on for all the additional AI deployment that they see for this year.
Is this any sort of bellwether that we can take away for CapEx with respect to this, or they just don't want to do it by themselves because they're a little tepid?
I mean, look at the Project Stargate announcement and all these companies, I feel hyperscalers, they have the balance sheet to do it themselves, but it's like, you're taking on a lot of risk if you do everything on your own. And that's where, especially with getting the proper real estate, getting the power and the other infrastructure requirements sorted out, there is a lot of expertise that they may not have in-house. And that's where I feel like it makes a ton of sense for them to partner with these PE guys who are probably more sort of experienced when it comes to getting land and setting up these large data centers.
Would this be equity or debt, a combination? What do we know at this early stage?
I mean, for I think a firm like Apollo, they would be taking on debt for sure. And so I think the good thing is these hyperscalers also have a big investment in that. So, a firm like Apollo is not taking all the risk when it comes to setting up the data centers. And we have that, .com bubble reference where the telecom companies did end up taking a lot of debt to set up the infrastructure. So in this case, it looks like it's a partnership where both of them are sort of taking on that risk when it comes to setting up these large data centers, expensive data centers, mind you. And I mean, a lot of these AI data centers, when you think about their power requirements, they are almost 10 times the power needed for traditional data centers. So there is a lot that's changing in terms of the data center profile, the power requirements, and that is what is adding to the costs here.
Did Mandeep just say my electricity bill's going up?
I think I might have heard that.
Anyway, yeah, go ahead.
Yeah, I'll just offer you one stat. So U.S. data center consumption before this AI wave was about like 5% of overall electricity consumption in the United States. There are some estimates that say it could go anywhere from 20% to 25% through 2030 because of all the AI deployments that we are seeing, and that's huge. So that will have an impact on everyone else because the power growth is not going to keep up with that sort of expansion.
And we need investment in the grid, Paul.
Yes, we do.
Being experts on that now. What's the? How much are we talking about the eventual AI infrastructure spending by Meta and everybody else?
Yeah, so this year, the total capex from the hyperscalers was close to 250 billion. We are expecting another 40 to 50% growth, so that will take you to closer to 380 billion for 2025. Wow. And look, the numbers are getting bigger and bigger, and that's the big bet when it comes to AI. Is we are still in the early innings, and I mean, there has been talks about $1 trillion in data center spending. So we seem to be on the path to do that. Whether there will be a digestion phase in between, I think that is the big question mark right now.
Mandeep, thank you so much, Mandeep Singh. He's a senior technology analyst for Bloomberg Intelligence, joining us via the Zoom thing, talking about some monster numbers. 250 billion in industry
Where are they
capex
for AI. These data centers?
I don't know.
Jersey,
I mean,
in the swamps?
It's a big country. There's a lot of places, but again, we talked about it.
Somewhere near a big power plant.
Exactly. I mean, or do you stick a little nuclear reactor next to these things? I don't know. So we'll keep an eye on that. 250 billion going to 350, 375 this year. That's real money. All right, folks, for our listeners in the U.S., a reminder, you can listen to us via satellite radio on Sirius XM channel 121. Access the world's only global audio business network, coast to coast, 24 hours a day. Bloomberg Radio on Sirius XM channel 121 is presented by Oracle. Stay tuned for the latest market news and industry research coming up. Looking at the markets, we've got decidedly green on the screen. It was mixed in the futures market, mixed here in the early trading today, but we've decidedly moved into the green here. I'm looking at Bitcoin, still down, but pared its losses. We're at $84,000 per token. We did get below 80,000 earlier in this trading session, so a bounce back for crypto. We'll have more coming up. This is Bloomberg.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been in U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
All right, coming up in this hour, scheduled is a tape playback. President Trump participates in a bilateral meeting with Ukraine President Zelensky at the White House. When that happens, if that happens this hour, we're going to bring that to you, but we'll stay on top of that. We're going to check in with Dr. Ariel Cohen, Senior Fellow at the Atlantic Council, joins us to discuss Trump and Zelensky and those meetings. It is Friday. That means we talk municipal bonds, baby. Eric Kazatsky, Bloomberg Intelligence Senior Municipal Strategist. He's going to join us. And then Miami, Mike McGlone, Bloomberg Intelligence Commodity Strategist. He's down there in Miami. He's one of the smart people. And he's also an expert on crypto. So it's off. It was off 25% from its peak just early this morning, but it's bouncing back a little bit. So we'll check in with Mike McGlone as well. Right now, let's kick this whole thing off, this hour off with Mr. Charlie Pelt.
All right. Thank you very much, Paul Sweeney. Do want to begin developing story headline right now off the Bloomberg Professional Service. The European Union poised to ask banks about delaying capital rules. Again, that headline right now on the Bloomberg Professional Service. We have got the Dow, the S&P, NASDAQ all moving higher now, wrapping up a tumultuous month for the U.S. equity market, a rebound in big tech, pushing stocks higher. Right to the numbers with the S&P now higher by 40 points, 59.01, up 0.7%. The Dow up 288, right now higher by 0.7%. NASDAQ up 151 for the NASDAQ Composite Index, a gain now of 0.8%. The NASDAQ 100 Index also higher today, up by 0.8%. The Russell 2000 Index of small cap shares up 0.7%. The 10-year 4.25%, with the 2-year 4.03%. Spot gold retreating by $27 the ounce, down 0.9%. 28.50. West Texas Intermediate crude below $70 a barrel at 69.89, down 0.7%. And Bitcoin now with an $83,000 handle, 83,900 on Bitcoin, down today by 0.4%. Victoria Fernandez is Chief Market Strategist at Crossmark Global Investments. And this morning on Surveillance, she told us there is a lot of uncertainty percolating around us.
Whether it's fiscal policy, trade policy, regulatory policy, monetary policy, all these things are, there's not a clear path forward. So we're continuing to be really judicious, but being invested in this market.
Crossmark's Victoria Fernandez interviewed this morning on Bloomberg Surveillance. After earnings, Dell down 5.7%. After earnings, we've got Autodesk down now by 3.7%, and Hewlett-Packard Inc., HP Inc., lower by 6.7%. Developing story out of Intel, it is further delaying the opening of a much-touted new semiconductor complex in Ohio, marking the latest setback to the chipmaker's expansion plans. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
All right, Charlie Pelleton, thank you so much. We appreciate that. John Tucker sitting in for Alex Steele. I'm Paul Sweeney. We are live here in our Bloomberg Interactive Broker Studio in New York City. We're streaming live on YouTube, so head over to youtube.com, search Bloomberg Podcasts Live, and that's where you'll find us. We have some economic data here this morning. The PCE data came in right in line with expectations. Core PCE on a month-to-month, 0.3%, and on a year-to-year basis, 2.6%. So right in line with expectations. Actually, a little bit of a tick down from last period here. It's kind of driving the markets a little bit higher here. We're at the intra-session highs here for the S&P, Dow, and NASDAQ. So we'll keep an eye on that, as Charlie Pellet just reported. Let's check in with Vince Signorella, Bloomberg macro strategist. Hey, Vince, what did you make of the economic data today and the price action we're seeing today?
So you make a good point about inflation. Consumers, or I should say the market, like that one. A lot of chop in the beginning, struggling for direction. A lot of futures algos back and forth, trying to shove it around. Ultimately, obviously, the buyers are winning the game at the moment. But there's other data that came out this morning, which was a little confusing. I shouldn't say confusing. It's in line with what we've seen from sentiment numbers. And it doesn't necessarily point to positive outcomes for me going forward. And that's, we saw a jump in personal income, which is obviously a good thing, but a drop in spending. So it relates to the sentiment numbers that we've been seeing, where consumers are concerned about inflation, and they're concerned about tariffs going forward, and they're concerned about their jobs. So the folks have money out there, or so it seems, but they're not necessarily spending it. So that trends forward, it's going to translate into slower growth. We'll have to wait and see how that plays out.
And we know it's the consumer that drives this U.S. economy. Vince, what is the smart money telling us right now? What are the signals they're sending?
Well, I mean, the smart money has got the S&P cash at 5,900, up about 40 points on the day, so they're liking it. We tend to get lately these positive morning sessions. And then we get Trump saying something in the afternoon that drives things lower. So we're going to see what happens in the afternoon session. That's been wrecking these markets if that continues. He may make some comments after he meets with Zelensky, and we'll see how that goes.
So, Vince, again, that real personal spending, just for folks out there, came in at negative 0.5%. The consensus expectation was negative 0.1%, and that's down substantially from last month when it was positive 0.5%. So yes. I'm hearing, Vince, maybe just it's because the market's been selling off the last few days, but I've been hearing more and more of our guests. They say, by and large, near term, we're cautious here. We just don't know how things are going to play out. Back half of the year, maybe we have some more confidence, but right now, caution is the word. Is that what you're hearing from the traders?
Yeah, pretty much. I mean, we've got tariffs expected to go into place next week, and one of the things we need to look for going forward into the numbers that'll come out later in March and probably more likely in April is, with tariffs kind of being thrown out there a month ago as to when they were going to hit. Have we seen some front loading in growth? I think we could say that we might have seen that in Canada this morning with their GDP beat. Their exporters, or I should say importers into the U.S. probably picking up on inventories, trying to get ahead of the tariffs on both Mexico and Canada. That makes perfect sense. We'll look at Canadian numbers going into April, see if it shows up some sort of a slowdown because of that front loading. But I think you could say the same for the U.S. consumer. I mean, to some extent, U.S. consumers are looking at tariffs and saying, do I want to pay 25% more for goods that I'm importing from Mexico or Canada? Should I load up a little sooner? And that may have been the reason for the drop in spending. It's going to need at least another month to look at to see if that trend continues. And that is the uncertainty in the market, actually, yes.
Mike from the fifth floor just writes in, Atlanta Fed GDP now, Q1 to date, negative 1.5%. Wow.
Yeah, there you go. I mean, that's a real possibility.
Is there a new Trump trade you see emerging, like maybe defensive stocks, healthcare, that sort of thing?
That's a very good question, John. You know, to be honest, he changes his mind every week, so it's really hard. It's really hard to pin it down.
All roads lead to the Mar-a-Lago or the White House, but it's not a straight line, I guess.
No, and I mean, you know, maybe something in the area of U.S. goods. I mean, if we get 25% tariffs on European autos, does that help the U.S. auto industry? Maybe not, because we're getting a lot of parts for those autos coming in from Canada and Mexico. So it's kind of a little bit of a crosswind both ways. You can't really look at pharma or the health stocks because they're looking to cut it down on drug prices. So. There's a lot more negatives, I think, and a lot more, as you say, let's wait and see and show a little caution to see where all the chips fall, because it's pretty tough to predict right now.
All right, Vince Signorella, thanks so much for joining us. We appreciate it. Vince Signorella, Bloomberg macro strategist. As John, as you know, the White House, as for every president, puts out a daily schedule for the president, what meetings he has, and so on and so forth. He'll be jetting off to Mar-a-Lago this afternoon, and I would do the exact same thing. I mean, it's cold. Go down to Florida, man.
Why not?
I mean, I played that golf course way back in the day. It's pretty good. So why not go down there and play some golf, jump in the water? I would do the same things, particularly if I had a jet in my disposal, like Air Force One. Why wouldn't you?
Well, Truman called it the Winter White House down in Florida.
Okay, very good.
Is that what we're calling Mar-a-Lago?
Yeah, I don't know. All right, let's check in on what's happening down in D.C., because, again, Mr. Zelensky is scheduled to be at the White House this morning, right now, as we speak, speaking with President Trump. Dr. Ariel Cohen joins us. He's a senior fellow at the Atlantic Council. Ariel, realistically, if you're Mr. Zelensky, what are you hoping to achieve today?
I would try to get as much or as many security guarantees from the United States, and also put on the table the following. In order to keep Russia at bay, if they go to a ceasefire now, or maybe eventually to a peace treaty, they will need about 10 brigades of peacekeepers in Ukraine, well-armed and potentially backed up by the NATO nuclear umbrella. This is the conversation that needs to happen in the Oval right now. Anything short of that, Zelensky is giving Trump something which is very vague about critical minerals, rare earth. We don't know where they are. Some of these rare earths are under Russian occupation in the eastern Ukraine called Donbass. In the end of the day, the market for rare earths is $3.5 billion. 65% of mining is dominated by China. 85% of processing is dominated by China. So we're not talking big bucks. If, on the other hand, Trump tells his audience, his electorate, look, I got this wonderful agreement. Now we need to back Ukraine. That is a Trump political, domestic achievement. And if that's where he's going, more power to him. But in the end of the day, the long-term American interests do not change based on who's in the White House. We, the United States, have an interest in keeping Russia out of Europe, keeping Europe from being dominated by one hostile power, being Nazi Germany or Kaiser's Germany or the Soviet Union or Russia. And as long as Mr. Trump keeps that in mind, he can run with that policy and do whatever he wants.
Is there a historical precedent for getting something like a mining deal or whatever it is, metals deal, in exchange for, yeah, we'll protect you now? Sounds a little like extortion.
I did not hear the language of exchange for protection. What Trump is saying
is... Well, it's kind of implicit.
No. The United States, Trump says, gave Ukraine assistance. There's a huge debate how much. Trump said 500 billion, then he said 300 billion. The Europeans did the calculation, said, it's more like maybe 120 billion. and the Europeans are saying they gave as much. But Trump is trying to recoup that assistance with this deal. In 1,000 years, that particular deal is not going to provide the U.S. with $120 billion. And Trump is not talking about security guarantees. And the precedent I'm thinking about is Franklin Delano Roosevelt, by all accounts, one of the greatest strategists, maybe the greatest strategist sitting in the White House since George Washington and Thomas Jefferson. In 1940, when Britain needed these naval destroyers, gave them 50 naval destroyers from World War I, older ships, in exchange for 9 naval bases in the Caribbean and Newfoundland. So it was basis for destroyers deal. The destroyers were not for free, and this was the beginning.
But that was sort of to appease the isolationists in Congress, wasn't it? It wasn't.
Well, we have isolationists in Congress right now.
Yes, we do.
And the MAGA electorate, America First, is the same slogan they had back in 1940.
Ariel, if you're President Putin, how do you think he views what's unfolding, A, in the United States White House with President Trump coming into office, and then, the need for peace at some point? How do you think, where's Mr. Putin these days?
It's a great question. Putin always puts up this, gamer face, poker face, and says, oh, Russia is winning, we're doing so great. In reality, there are reports now that they're sending soldiers on crutches back into front line. They're using some donkeys instead of trucks. I don't know how true that is. They try to use North Koreans. We saw this is not going anyplace. They're reaching out to Nepalese and the Cubans to send to be killed in the front line. They're not gaining a lot of Ukrainian territory, although Ukraine, population-wise, is what, 5 times smaller than Russia? Economy-wise, maybe 7 times smaller than Russia. So Ukraine is putting up a heroic fight, but the fight is not about Ukraine. The fight is about European security and ergo, therefore, the balance of power in the world. And to keep that balance of power, to keep hostile powers such as Russia and China away from Europe, this is an American interest, but it's also in our interest that our European allies start putting their big boy pants on and paying up, because the Europeans were not sustaining their fair share in NATO defense. Barack Obama and Joe Biden kept telling them that. Donald Trump has a different style.
What kind of shape is NATO in right now?
NATO is not having fun because the European and the American military-industrial production is matching what our needs are. And our needs are not only Ukraine, but potentially China. Therefore, the defense stocks were doing very well and probably will continue doing well, not only because of Ukraine, but also because of the Pacific. The Europeans need to get their act together. NATO needs to get their act together. And once they think, and Trump wants them to think that we're pulling out, Britain, Germany, and France should find their way to manage NATO in Europe and to lead both on the military-industrial front and on the manpower, on personnel front. Can they do it? That is the $64 billion question.
Ariel Cohen, thank you so much for joining us. Ariel Cohen, he's a senior fellow at the Atlantic Council, joining us from Washington, D.C. Via Zoom. And again, President Trump meeting with President Zelensky at the White House, scheduled to have a tape playback of a meeting between those two. And whenever that is made available to us, we will bring that to you. It's supposed to be an 11 o'clock hour, but with these things, John, you just don't know.
Yeah, I wouldn't set your clock to it.
Yeah, they just don't feel, the politicians don't feel the need to be on time for stuff. It kind of can
Don't they listen to us?
Yeah, exactly.
That we have to fill?
Exactly right. So we'll have that when it comes up. All right, coming up, we're going to check in with Eric Kazatsky, talk about the municipal bond market. Eric Kazatsky is a Bloomberg Intelligence senior municipal strategist. Give us a sense of where to make money in the muni bond business. Again, for those of us in high tax states like New Jersey, triple tax free on those bonds. Makes them very attractive investments for a lot of folks. Mike McGlone, Bloomberg Intelligence Senior Commodity Strategist and the de facto mayor of South Beach, Miami. He's going to talk to us about Bitcoin. It was down 25% earlier this morning from its high set back in just a couple of months ago. It's rallied a little bit here now, only off about 0.7%. So with the latest on the crypto space. S&P, the cash market, we were up 21 points. The Dow's up 175, and NASDAQ's up 65 points. That's 0.3%. We're going to have more coming up. This is Bloomberg. Good morning.
Theories about that.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 11:21 on Wall Street. We do check markets all day long here at Bloomberg. Stocks higher. S&P 500 index back in the green for the year. This Bloomberg Business Flash brought to you by Oracle. Attention growing businesses. Oracle is offering to cut your current cloud bill in half if you move to Oracle Cloud Infrastructure. For new U.S. customers with minimum financial commitment, offer ends March 31st. See if your company qualifies at oracle.com/Bloomberg. A rebound in big tech pushing stocks stocks higher. S&P right now up 27 at 58.89, up 0.5%. The Dow up 211, up by 0.5%. NASDAQ up 91, up by 0.5%. The 10-year 4.22%. The 2-year 4.00%. Gold down $27 the ounce, down 1%, 28.49. West Texas Intermediate crude down 1%, 69.63 a barrel. And Bitcoin 83,745, down 0.6%. As for the market backdrop, Vince Signorella follows markets for Bloomberg, and he was a guest moments ago right here on Bloomberg Intelligence.
The smart money has got the S&P cash at 5,900, up about 40 points on the day, so they're liking it. We tend to get lately these positive morning sessions, and then we get Trump saying something in the afternoon that drives things lower. So we're going to see what happens in the afternoon session. That's been wrecking these markets if that continues. He may make some comments after he meets with Zelensky, and we'll see how that goes.
And, of course, keep it locked into Bloomberg for the latest. BlackRock, meanwhile, scrapping its aspirational workforce representation objectives, reversing course on earlier goals after President Trump moved to end diversity, equity, and inclusion, or DEI, practices. Recapping stocks higher, we are off session highs, but the S&P right now up 0.4%. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
Now on Bloomberg Intelligence, Munis in Focus.
All right, today's Focus on Munis is brought to you by BAM Mutual. BAM Mutual insures municipal bonds that finance essential infrastructure and provides guaranteed income to improve any portfolio. Learn more about municipal bond credit quality. Visit bamBonds.com. Let's talk about it. BAM. Yeah, absolutely. We need Matt Miller here. Eric Kazaski joins us here, senior municipal bond strategist for Bloomberg Intelligence, safely ensconced down in Princeton, New Jersey, where they have the really good lunches, by the way, and good eats overall. Hey, Eric, talk to us about the municipal bond market. I'm looking at the INGO function. The municipal bond, the Bloomberg Municipal Bond Index up 1.46% this year, but that's lagging the Bloomberg Ag. So what's happening in the muni space?
Yeah, we're certainly underperforming treasuries, as part of this most recent rally. And that's really to be expected. We don't move lock and step with our taxable equivalents. We usually take a little bit of time to catch up. And really, we're sort of hinging on what's going to be happening on the federal level with tax reform and ultimately what happens to the future of the tax exemption.
Oh, you talked about performance, so that begs my stupid question of the day. Are people buying these bonds for the price appreciation or for the yields and its tax-free status?
Yeah, I mean, with the equity sell-off, right, we are certainly taking advantage of that flight to safety, flight to quality trade that money's coming into bonds. And certainly from an uncorrelated risk asset, munis are a lot less risky than corporate bonds. So we should look attractive from a total return standpoint. But, I think really the play in munis are those tax equivalent yields. A high tax New York, New Jersey buyer, you're getting close to 6% on a tax equivalent basis. I mean, that's really up there when it comes to comparing to corporates and what sort of risk you'd be taking on with those.
All right. So, Eric, where are we on, this threat to municipal tax exemption? Any discussion, or is it just too much noise going out there?
Too much noise right now. But most interestingly, I really think it's a fact of, what new threats have sort of entered the chat, so to speak, right? And what we've gotten over the last week is a House bill that was introduced to raise the tax level on endowments for those universities that have very, very high levels of endowment, looking at Harvard, looking at Stanford, looking at Princeton, those sort of things. And that could actually cost them in their wallet. And, are we going to see spreads blow out on these AAA credits? Probably not, but certainly it could point to weakness over time. Another thing that we're keeping an eye on is the noise coming out of Florida, where Governor DeSantis is talking repeatedly about trying to get rid of property taxes. And about $9 billion of the state's debt load is backed by ad valorem property taxes. So they would have to find a replacement revenue source. Really a conundrum there.
What would that replacement be? Let's.
I mean, it would be an income tax or increasing the sales tax. I mean, you can't just take it away and assume that there's going to be an equivalent funding source that's just going to magically appear, right?
Yeah, like I don't know. And somebody asked, I guess I could Google it. How do you have a state like Florida or Texas not having income tax? What's their replacement revenue for all the income tax that the rest of us pay in the rest of the country?
Well, I mean, a lot goes down to the local level. It's coming from, property taxes, which is really sort of the genesis of his talking point. Between property tax levels and insurance levels in the state, it really is crushing a lot of homeowners, especially seniors who have moved there and they're on a fixed income. So I understand it, and it certainly is a populist thing to get behind, right? No one wants to pay more tax, but taking away the property tax support and the revenues that are coming in, it's paying for police, it's paying for fire, it's paying for road repair, it's paying for schools. So those things need a funding source, and he hasn't proposed a new one yet.
Okay, let's talk about issuance. Who's, I mean, what's happening around the country? Who's doing what?
Yeah, I mean, issuance is pretty strong this year, and a lot of it is coming from that sort of fear trade with bankers going out and saying, hey, the exemption's at risk. We want to get out ahead of this. And we saw supply, hit, almost an all-time level last year. We're up about 28%, 27% this year, year over year. So very strong start. Looking forward over the next month and a half, it's interesting, right? We talked about what that was proposed in Congress as far as, taxing those higher endowment level schools. And not surprisingly, we saw Harvard and Stanford pop onto the forward calendar, both with fairly sizable deals. So, take with that as you will.
Do you does the market like that higher ed stuff?
I mean, with a AAA credit like
Yeah.
that, I mean, yeah, they love it. And it comes in size, and it's pretty liquid name to trade around.
Yeah.
Stanford is coming with a taxable deal, so we haven't seen a lot of issuance on the taxable side. We are hopeful that with this rate rally, that's going to bring that section of the market, back into something of more liveliness.
All right, Eric, good stuff. Appreciate it. Eric Kazatsky, Senior Municipal Bond Strategist for Bloomberg Intelligence. We go from Princeton down to Miami Beach, baby. South Beach. Mike McGlone, Bloomberg Intelligence, Senior Commodity Strategist. Hey, Mike, I had a print on Tom Keen's Bitcoin below $80,000 earlier this morning. We're now kind of back to around 83,600. Is this just a fear trade coming in? People are concerned about the near term, whether it's policy changes, whatever. Is that what we're seeing in the crypto space?
I think it's just taking back the excessiveness of that rally we had to the peak, up to just above 100,000 in Bitcoin, and it was way overdue. So today it got back to the 200-day moving average. I like to watch Ether for great technical indications. It's trading between 2,000 and 4,000 forever. It just dropped in near 2,000. So the market's near some good support levels. But the big picture macro for cryptos is just plain bad for prices. And I like to point out there's unlimited supply. So to me, that 10,000 level in Bitcoin looked very similar to the NASDAQ 25 years ago. You remember that one? I mean, I remember it well. To me, it's almost exactly 25 years ago. Just the bell was ringing that, yeah, this is kind of silly, stupid, expensive, and I think that's the problem. We're still silly, stupid, expensive. We reached good, decent support, but the problem is, the big picture, I think, is anybody who's bullish cryptos, I like to say, yeah, it's probably okay. It might not go down as long as the stock market keeps going up.
Can you talk about just the construction of Bitcoin and if that implies any sort of vulnerability in Bitcoin?
Well, John, the key thing about Bitcoin is, and that really brought me into the space that got me really bullish, like 8 years ago, is definable diminishing supply and increasing in demand and adoption. Now, when Mr. Trump was first elected in 2016 on CoinMarketCap.com, there's about 600 cryptos. I'm like, okay, that made sense. Now there's 12 million. And before he got elected, there's about 2 million. There's unlimited supply. So we've unleashed the animal spirits in this space. You remember pets.com. I remember trading that stuff and just kind of having fun. And that's what we are now. So I think that's the thing. The space, I think, had its best bullish inclinations ever last year when Mr. Trump switched from antagonist to zealot. But now it's just, to me, it's just way too expensive. And the key thing I like to point out is things like Dogecoin and Shiba Inu are just jokes. Bitcoin has a much higher correlation to them than to the stock market, and they're all positively correlated, which means that's the problem. And I think it's just showing we're taking out some of those excesses of speculation and liquidity in all markets. And remember, the stock market's still very expensive.
All right, John, you ready for this? Miami today, mostly sunny, 78 degrees. I mean, if you're into that kind of thing for February, then more power to you. But I mean, I don't know.
Paul, you always get me back in July, and I earned that. You always get me back in that heat and humidity.
Exactly. All right, let's switch on the commodity front here, Mike. WTI crude oil sitting here just below 70. I'm calling it out for Alex Steele because she's got this on her speed dial. What's the crude call here these days?
60 next. I think it's breaking down to 60. Yeah, first of all, let's not underestimate our administration. We have a new administration that wants lower crude oil prices and lower yields. And guess what's happening? They're both falling. And they have fundamental reasons in their space. So for crude oil, we have an excess supply out of the U.S., Canada, and OPEC. And just on the terminal later today, decreasing demand from the largest demand source for the last 10 years, and that's China. The space for crude oil is very negative, and we have managed money net position still long. So I think crude oil is just a matter of time. It has to get below that U.S. cost of production, which is around $56, $57 a barrel, according to Bloomberg New Energy Finance, to shut off this excess of supply versus demand, which is the way it always works. So I'm still bearish crude oil. I think copper's even peaked. Most commodities looks like they have peaked, and crude oil is just the one that really matters.
Oh, wait, I heard something about levies on Canadian energy products starting, what, Tuesday?
Yeah, okay, so that short term might be a bit discombobulating, but the key thing about, just think about just a few years ago, the U.S., we have a metric on the Bloomberg terminals called crude oil net imports. Well, now it's negative because the net exports of crude oil and liquid fuel from the U.S. is around 4 million barrels a day. Now, there's certain grades that'll come between U.S. and Canada that will mess things up a little bit, but in the macro, we have an excess supply of liquid fuels, crude oil, natural gas, and most notably grain. So in the macro big picture, as we kick into a bit more of a trade war with tariffs, it's going to pressure those factors unless we can get some countries to say, okay, we'll buy more of your stuff. But in the meantime, we do have excess supply, and we have a motivated government, and the trend's not friendly. I also look at natural gas. It looks like it just peaked around 4. In the last 10 years, every time it gets near 4, we find new supply, and it drops to near 2.
See, there you go. That's what the... See, I've been through one season of Landman, so I'm an expert on all things energy, oil and gas.
I didn't get my chicken question in, and egg prices.
Well, we'll save that for next time. We'll do that. I don't know if he does chickens and eggs and things like that. What came first? Mike McGlone, senior commodity strategist. He probably does. He covers everything. So he came off the farm in the Midwest, so he knows soybeans, he knows corn, he knows all that kind of stuff. And now he's shaped himself into like an expert on crypto. And he's in the self-proclaimed crypto capital of the world, which is Miami.
Which was a very smart move.
That was. It was, exactly right. So good stuff there. Looking at the markets here, a little bit of green on the screen here to end up what has been a tumultuous week. We're going to have more coming up. We're going to check in with Michael McKee. He does all the economic stuff for Bloomberg. And I want to ask him about some of this inflation data, some of the other data we saw today. How does that impact his economic outlook and what he's seeing out there on the street? Again, Bitcoin off $450. That's a 0.5%. That's now 83,800 on Bitcoin. That is a Tom Keene Memorial quote for Bitcoin. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 11:40 on Wall Street. We do check markets all day long here at Bloomberg, and this Bloomberg Business Flash is brought to you by Commonwealth. Join over 2,000 independent financial advisors who are taking control of their growth with advisor-centric support and future-ready technologies. Grow on your own terms with a partner dedicated to your success. Go to Commonwealth.com to learn how. Do want to begin with a number of headlines on Ukraine out of the White House. President Trump saying we have something that is a very fair deal. The president says a deal with Ukraine is a big commitment from the U.S. Ukrainian President Vladimir Zelensky at the White House says hopefully the document will be a step forward. And President Trump adding that he has spoken with Russian President Putin and did have good discussions with Russia. Equities higher. We are seeing a rebound in big tech. S&P right now up 32 to 58.94. That is a gain of 0.6%. The Dow up 226, up 0.5. NASDAQ up 0.6%. The NASDAQ 100 index also higher by 0.6%. The 10-year 4.24%. The 2-year 4.01%. Gold down $26 the ounce at $28.50, down 0.9%. And West Texas Intermediate crude down 0.9%, $69.70 for a barrel of WTI. The Fed's preferred measure of underlying inflation rose at a mild pace in January. And with that story, here's Bloomberg's Vinny Del Giudice.
It's reassuring data after a series of reports suggesting U.S. inflation is heating up again. Core PCE rose 2.6% in January on a year-over-year basis, matching the smallest annual increase in 4 years. In recent days, Fed officials have signaled they're in no rush to cut interest rates again until they see sustained progress in containing inflation. This may be a first step. Vinny Del Giudice, Bloomberg Radio.
Imagine this as you are checking your bank account. Citigroup erroneously credited $81 trillion to a customer's account instead of $280 last April before reversing the transaction hours later. This according to the Financial Times. The transfer was missed by 2 employees and detected by a 3rd employee 90 minutes after it was posted. Citigroup shares today down 0.5%. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
All right, Charlie Pelleton, thank you so much. We appreciate that. John Tucker sitting in for Alex Steele. I'm Paul Sweeney. We are live here in our Bloomberg Interactive Broker Studio in New York City. We are streaming live on YouTube, so head over to youtube.com, search Bloomberg Podcast Live, and that's where you'll find us. We got some economic data today on the inflation front. PCE, the smart folks look at that core PCE index month to month up 0.3%, right in line with expectations. On a year-over-year basis, 2.6%, again, right in line with expectations and a little bit lower than last period. That's the number, it's one of those numbers that the Fed would like to see closer to 2%. So maybe a little bit more work to do there. Priya Misra joins us, fixed income portfolio manager, JP Morgan Asset Management. Priya, what did you make of the inflation data? More importantly, how do you think our friends at the Federal Reserve are going to view this data?
So I think the Fed realizes that inflation is above target. They'd like it to be closer to 2%. It's at 2.6 year over year. So there's still more room for it to come down. But when we look at the details of the PCE report, we are seeing improvements across the board. There are a couple of components that are high, but they're heading lower. So I think it's good news, came in kind of as expected. It tells us that the Fed is in no rush to cut rates and they're going to stay on hold. We're actually, I think the market's focus is moving away from inflation now more to growth and all the policy uncertainty. But at least it was good news in the sense that it didn't pick back up, which was a concern late last year that inflation may be reaccelerating. I think we can put that fear aside. Now I think the fears are shifting to the growth side.
The Atlanta Fed GDP Now tracker, Q1 GDP growth now forecast at negative 1.5%. I mean, that's recessionary territory. Your take on that?
I think today's trade deficit came in so much weaker than people were expecting. We've heard that the gold imports from the rest of the world is one of the factors. So I'd say it's less about like a big slowing in growth, if it's all driven really by trade. But, I think the market is reacting to the fact that there is policy uncertainty. There's tariffs. We know tariffs are a stagflationary shock. What is Doge doing? So I think there are growth fears. I would put aside some of the Atlanta Fed recession fears. I think the hard data so far, tier one data, and we're going to get a lot of it next week. We're keeping a very close watch on the labor market, particularly. The hard data has been tier one data has been still strong. I think where the concern is some of the sentiment data, business uncertainty indices are picking up. I think, does this weigh on business investment, business